Okay, so just really briefly, a little bit about me. My name's Nick Seibert. You just call me Nick. You don't have to call me professor or whatever. Um, and I've been teaching for about 15 years. I got my PhD at Cornell in management and accounting. And for most of my career, actually right until last year, all I've taught is this class called financial statement analysis. And what we do in that class is we learn how to use the financial statements to analyze companies. And that includes, financial ratios and digging into the nitty-gritty accounting issues. And I'm teaching another session in about a month that covers some of that stuff. But the other big parts of it are forecasting financial statements and then using those forecasts to do valuation. And I know you guys have had valuation in some other classes, but we do it a little bit differently in accounting. And this is what I'm going to show some of it to you today. But so this is kind of material from financial statement analysis largely, okay? But specifically, I've boiled the content down to focus right in on the fact that we can use kind of the same financial statement numbers or the same set of financial statements for a company, and we can use all these different valuation models that you may or may not have been exposed to in some other classes. If you've never seen a valuation model before, I don't think that's a big problem because I'm going to try to go through the logic starting from kind of building from the ground up today. If you have seen some valuation models, I'm going to try to explain how ours might compare and contrast with what you've seen before. Okay. Anyway, so that's the introduction. Does anybody have any questions or concerns before we dig into this? Okay, and feel free if you have a question. I actually prefer that you just jump in and just like start speaking up. Don't be shy. Don't worry about interrupting me. That I'll be okay. I'm not great at looking for hands being raised, especially because you can't see it, but I've got a tablet down here. And so I'm going to be like writing and looking at the tablet a lot. So I might miss hands. So just feel free to just jump in and be like, oh, what do you mean by this? Or can you clarify something? That'll be fine. Okay, so the way that I kind of came up with this this Business Decoded section, and I mentioned this in some of my classes that I teach, but it's just kind of been nagging at me more over the years because I keep getting students who've had valuation, or even talking to some other professors at other schools, and they don't realize, or it's somehow like going over their head, or they just haven't paid attention that really all of our valuation models are supposed to give us the same value of a company. And if you look online, I just started Googling, right, and doing random screen captures of random websites. But a lot of these are like CFA, right? CFA study sites, or like websites that purport to be kind of like experts on financial analysis. And so we have this one that says, free cash flow valuation is preferred over the dividend discount model because, and we'll talk about both free cash flows and dividends today, okay? We got another one. Why is free cash flow approach better than dividend discount models? And we got one problem with the dividend discount model is that it cannot be used to value stocks that don't pay dividends. Okay, none of these statements are true. None of the questions make any sense. The free cash flow model and the dividend model are equivalent mathematically, and I will show you this today, okay? We will also be talking about income-based valuation. We call it the residual income model. And, in academia, amongst professors who do research, for those that were paying attention, this issue was resolved back in 2001 when the World Trade Center towers were still standing, okay? Like many of our undergraduate students weren't born when this issue was resolved. And I'm not going to read this whole abstract, but in short, there was a series of research papers that proved that discounted cash flow or free cash flow models and dividend models and residual income models all give you the same valuation. And it was kind of embarrassing for everyone who wrote papers and did valuation for the previous 50 years, because these papers basically showed that the reason these people were getting different valuations is because they were doing it wrong. Okay, like they literally had errors in the numbers they were using or their math. Okay, and so it is really tricky, these models, and getting everything right. And so that's what today is about. I'll walk through it with you and hopefully try to convince you that we should get the same valuations, but you got to pay attention and you got to use your numbers right. And that's what we'll try to do. Hopefully I won't make a mistake with my numbers today, and then because then we wouldn't get the same valuations. All right, so before we dig into valuations, I want to do a pretty basic, although it's going to get more advanced really fast, but a pretty basic overview of accounting, right? And those financial statements. Let's see, we have something in chat here. I'm definitely plagiarizing this intro in my next interview. Okay, feel free to plagiarize, academic free use of all educational materials. At least that's what I support. So there are three main financial statements, right? The balance sheet, the income statement, and the statement of cash flows. And then there's this fourth one that we kind of rarely talk about, the statement of stockholders' equity, which can be useful, but I always completely ignore it for purposes of valuation. But and I've learned for Flex MBA students, it doesn't make any sense to ask, who did you have intro accounting with? Because there's so many different years and different people in different campuses that people have had it with a bunch of different people. But I'm going to rely on, and this may be a big if or a big reliance, I'm going to rely on the fact that the person who taught you intro accounting did a decent job of it. And that may not be true, but I hope that's true. Oh, somebody said they had Darlene. Yeah, I know. I'm sure some people have Michael Kimbrough. Some people probably had Musa Subasi. I don't know. And I know there's some problems with those books and the online homework system and stuff like that. But let me just try to distill this down pretty simply, right? So we got these three financial statements. And what I've got here first is an income statement. Oh, you like Wiley Plus? Okay, that's Wiley Plus is, I think, better than McGraw Hill. Okay, anyways, so the income statement, this is the most simple, and it still has a lot of lines, right? What I have up here, but this is the most simple income statement that you can possibly have, pretty much, because you've got your revenues, which is, right, all the products that you've sold to customers in the MSRP terms, the actual price that the customers paid. So you've got your revenues, you've got right? So payments from customers for products or services, you're subtracting your cost of goods sold, and that's, right, basically the inventory costs or the manufacturing costs of the products, right? And then, so those are usually your two biggest items on your income statement. And below that, you've got your gross profit. Then you've got all these other operating expenses, which kind of makes our life hard for various reasons, right? Because you've got wages, you've got research and development, you've got store rental costs, you've got advertising, you've got all types of crap in your operating expenses. Okay. I see somebody else's, people are still responding to who they had for intro accounting. Let's see, there's a diversity. People had a bunch of different professors. Okay. So, and then we've got a couple other things down here, such as, let me get my pen out here. And we won't be talking much, if at all, about this today, because I'm trying to make stuff simpler today. But you've got these non-operating expenses. The only thing I want to point out here is that the non-operating expenses is where your interest expense goes. So the interest that the company pays on debt, that comes in that line item. But it comes with other stuff too, which can make that line item very confusing. And then, of course, the company has to pay taxes, blah, blah, blah. But that's your income statement. And the key point here, though, is what is on the income statement fundamentally? It's the selling of the goods or the services that the company is producing and selling. And then it's all the costs and expenses that are related to selling the goods or services. So the income statement really deals with the fundamental operations of the company. Okay, it's an operating statement. And at the bottom line, of course, the all-important net income, which for finance people, they love to just call it earnings. Okay, but so when I say earnings, not everybody means the same thing by that. But when I say earnings, I mean net income, because that's what earnings is in accounting terms. Accountants always think earnings is net income. Okay. All right. Does anybody have questions about the basic income statement before we continue? Concerns? I mean, if you have concerns about the income statement, there's not much I can do. This is how accounting principles say that this thing has to be produced. So, okay. So then we have the balance sheet. And of course, and we're going to come back to this. We're going to get into some math, like a little, not too complex, but we're going to have some equations. And so the simplest equation, before we start like kind of switching sides of things and manipulating the equations, is of course just the fundamental accounting equation: assets equals liabilities plus equity, right? Assets equals liabilities plus equity. And I've got a balance sheet here, and I've simplified it a lot, right? So normally when you see a balance sheet, you might be expecting cash, accounts receivable, inventory, property, plant, and equipment, right? All that stuff. And then on the liability side, you might expect like accounts payable, short-term debt, long-term debt. All those things are there, but I'm just distilling it down to the basic categories. And I hope you'll see why in a minute, because if I didn't do this, I wouldn't be able to do a bunch of slides that are coming up. Okay. So on the balance sheet, what we really have is we have cash. Cash is king, right? Always have cash. Well, hopefully your company has some cash. Otherwise, your company's in trouble, right? But then we've got operating assets. And remember, I just said that the income statement is kind of an operating statement. It's because the operations of the company are the selling of the goods and services, right? So operating assets are the assets that are related to the company generating that income, okay? Doing its main line of business, whatever it does. And so we see accounts receivable. Well, that's accounts receivable is money that customers owe you, right? For what? For products or services that you sold the customers, okay? Inventory, that's obviously the products that the company makes, right? So these are our operating assets. And there are only two classes of assets in this framework, in this simplified framework. You're either an operating asset because you're part of the general day-to-day business, selling of the goods and services, or you're an investing asset. And the investing assets tend to be the longer term assets. They don't have to be, but they tend to be the longer term assets, such as property, plant, and equipment, right? The building that you bought to manufacture your product, and you're going to use that building for 30 years. Okay, so that would be included in investing assets. And then we've got other stuff like goodwill. We don't need to really get into detail about this stuff today, but goodwill is when you have acquired another company. Okay. And then marketable securities. This can be a tricky one for people, but that's just when a company buys stocks of other companies. So Apple's great on this. Apple has like hundreds of billions of dollars of stock in other companies. So Apple's like its own hedge fund. It owns Microsoft stock, and it owns Google stock, and it owns all kinds of stocks. So on Apple's balance sheet, you'll see hundreds of billions of dollars, like half of their assets or something, are these marketable securities. But so we can break assets down into basically operating versus investing. Then we've got liabilities. Liabilities also have operating liabilities because these are the liabilities that go into the day-to-day operations. Again, buying and selling and manufacturing the products that we have. And so what do we have here? We've got accounts payable. That's the flip side of accounts receivable, right? Accounts payable is money that the company owes its suppliers. What do they owe the suppliers for? The inventory that they're selling, right? So again, that's part of the day-to-day business operations. Wages payable, that's money that you owe to employees, right? Hopefully you don't owe that money for too long. Hopefully they pay the employees pretty quickly, but you might see wages payable. And then taxes payable. And some people are like, why is taxes operations? Well, because what does the company pay tax on? They pay tax on their income, right? So they are paying tax on their operating profits. All right. So those are the operating liabilities. And there again, and just like assets, there's only one other type of liability, except it's not investing, it's financing. And financing liabilities is just another word for this is just debt. And so the intro accounting classes love this stupid account, notes payable. You rarely see notes payable on a large corporation's balance sheet, but it's like the favorite form of debt in intro accounting textbooks. But so it could be notes payable. You might see some bonds or bonds payable, and then you might see short-term or long-term debt. And that's actually the most frequent one that you see is just long-term debt or term debt on companies' balance sheets. Okay. So that's the assets and liabilities. So you've got your operating elements, and then you've got investing assets, and then you've got financing liabilities. And then all that's left, and we're going to spend a bunch of time with equity today because our valuation models, we're going to be valuing equity. We're going to be valuing like the stock of the company, and that heavily focuses in on this equity element. So equity also has basically just two categories: invested capital, and that is it's called investment because it's like what the shareholders put into the company. And that is captured in common stock and additional paid-in capital. And I don't know if you guys remember, it's not like super critical, but from your intro accounting, that additional paid-in capital is actually where most shareholders' investment ends up going, because in the common stock account, it's just this thing called par value, which is like a fraction of a cent of each share of stock. So if you want to think about the total shareholders investment in stock, you've got to kind of add those two accounts together, common stock and additional paid-in capital. Let's see, we got a chat thing here. Goodwill equals fake assets can be used to deceive. Yeah. I mean, goodwill, we're not going to touch much on goodwill today, but goodwill is essentially what happens when you buy another company and you pay more than that company is quote unquote worth based on their current stock price. And so then you have goodwill. And so it's supposed to be this special type of value, because like, why else would you overpay for a company? You must have paid for some value, right? And so I totally agree with the chat comment. I think a lot of goodwill represents bad decision making, but that's not really going to affect our issue, what we talk about today. But that's a very good observation. All right, so then besides invested capital, we have what we would also maybe term earned capital, but let's just use the word that's on the balance sheet already: retained earnings. And retained earnings has a little formula for it, okay? And so, this is important because retained earnings is going to come back and equity is going to keep coming back in our valuation models. So we need to I need to hammer this so that we understand it. So retained earnings, I think of it this way, right? I think of retained earnings as this bucket. And every single year as time marches forward and the company earns money, right? So at the end of each year, you've got a net income for the year, or an earnings, however you want to think about it. That net income drops into the bucket. And then the bucket just keeps pushing forward to subsequent years. And each year, net income is getting dropped into that bucket. And only one thing ever gets pulled out of the bucket. And that is ordinary dividends, or dividends paid to shareholders gets pulled out of the bucket. So the only things that affect the retained earnings bucket: income goes into it, dividends come out of it. And that's what this equation down here is, with our mathematical terms, retained earnings at time T, right? T is now, is equal to last year's retained earnings, T minus 1, plus net income minus dividends. So that's all that's saying, is that if you want to get from last year's balance sheet retained earnings to this year's balance sheet retained earnings, we just add this year's net income and we subtract any dividends that we paid. The reason, just to preview, the reason this is going to be important is because one of our models is the dividend discount model. So we need to have a really good understanding of, okay, ordinary dividends gets paid out of retained earnings. And the only things that affect retained earnings is net income and dividends. Does anybody have a question about that? We will come back and talk about that again. So, okay. All right. So I said we're going to do some equations, and it's not hopefully too bad, but this is just, so this is going to get us to the logic of how cash flows work, of how a company's annual, and a cash flow, by the way, is just the change in cash over the year that a company has. So that's all a cash flow is, the change in cash during the year. So I'm going to start with that basic fundamental accounting equation, right? Assets equals liabilities plus equity. That's just the fundamental equation we just saw a little bit ago. And then I'm going to start making some modifications to it. So the first one, from our math terminology, I'm putting deltas here. So the triangle is the delta, and that just means the change in. Right. And so we know mathematically I can do that, right? The change in Nick's body weight is affected by the change in the calories that he takes in. We know that for sure. It's been tested the last week. So here we just have the balance sheet equation. The change in assets equals the change in liabilities plus the change in equity. That has to be true, right? If these things are all related to each other, then they have to change together, right? Okay. Then it's getting a little more complicated. I'm splitting assets into two categories. And we know that I just had three categories on the previous slide: cash, operating assets, and investing assets. We don't need to get that complicated here yet. I'm just saying, hey, let's split assets into cash and then everything else, cash and non-cash assets. So mathematically, this must be true, right? I don't think this step should be controversial. And then all I'm going to do now is I'm going to move one of these terms to the other side of the equation, right? So all I did was essentially move non-cash assets over here to the other side. Okay, 6th grade math. I think I have a kid in 7th grade now, so I now feel confident. I used to say 5th grade math, but I now believe this is 6th or maybe 7th grade math. But anyhow, we should be able to do that. So why did I do this? The reason that I did this is because now I have the change in cash over here by itself. And the change in cash this is on an annual basis. You could think of this on a quarterly basis too, but I think for simplicity and all our valuation models are on an annual basis. So I think of all this stuff as yearly financial statements and yearly changes. So the change in cash for the year is going to be exactly equal to the change in liabilities plus the change in equity minus the change in non-cash assets. So what's this telling us? It's telling us that every time a liability goes up, cash is going to go up. It's telling us every time equity goes up, cash is going to go up. But then look at the last term. Look at the sign. It's negative. Every time an asset goes up, cash is going to go down. Now, why is that? I'll give you an example. What's an example of an asset? Property, plant, and equipment, buildings. How does a building magically appear at your company? I don't think anyone's going to just magically donate that to you, right? You bought the building. Okay, what did you buy it with? Cash, right? I mean, you could have gotten a loan or something, but that's why we look at everything here. We look at everything from liabilities all the way, equity and assets. But essentially, you can't generate assets out of thin air. You must have paid cash for it, okay? If you have a liability, what's a type of liability? Debt. So if you take on debt, like a bank loan, right? What do you get when you take a bank loan? I hope cash. Right? I hope cash. So if liabilities goes up, cash is going to go up because you took on debt. So
is this okay?
Okay. Somebody's unmuted, but if you have a question, let me know. Because we're going to get a little more complicated here, but the point here is just that if we're trying to look at the changes in cash for the year, they're positively related to liabilities and equity changes, and they're negatively related to asset changes. Okay. And this is the logic that underlies the cash flow statement. And the cash flow statement, unfortunately, because we use numbers from the cash flow statement in a couple of our valuation models, it tends to be the most hated accounting statement by not only students, but also frequently a lot of professors, okay? And the reason is it has so many sections to it, it has so many line items, and it has a really difficult logic to it. I don't think it's difficult anymore, but I've been teaching it for 15 years. And the logic is based on that previous slide, where how does a change in cash relate to changes in liabilities, assets, and equity? All right. So ultimately, the statement of cash flows, the whole point of it is it's going to look at all the changes in cash from different activities. And then at the very bottom of it, it's going to give us delta cash. It's going to give us the change in cash for the year. And that change in cash is going to, if you go back up to the balance sheet and look at what cash did from, last year to this year, it should have gone up or down by the same amount as the cash flow statement shows the change to be. All right. So the cash flow statement has 3 sections. One is much more annoying than the others. Although today I'm going to try to simplify it enough that it's not too much more annoying. And the most annoying section is the first one, the operating activities. Okay. Now remember, I said the income statement is like an operating statement, right? It's the company's day-to-day business operation, selling its products and services, right? Then we have investing activities. And guess what? The investing activities are going to be related to those investing assets, the property, plant, and equipment, and other long-term assets on the balance sheet. And then we have cash flows from financing activities. And guess what? These are going to be primarily related to those financing liabilities, debt, okay, bonds, things like all kinds of company debt that it uses to finance, and also equity transactions with shareholders, because the 2 types of financing, as you should know from finance class, right, is debt and equity, right? Those are both forms of financing for the company, all right? So we will get into this in more detail, all right? But so first, let's talk about the cash flows from operating activities. The operating activity, and this is at the top of the statement of cash flow. So it's the first section. So the operating activities section is, you can think of it as a cash income statement. Unfortunately, it looks nothing like a cash income statement, right? Because if you had a cash income statement, you expect to see cash revenues minus cash costs of goods sold equals cash gross profit minus cash wages expense, right? That's not what it looks like. It looks like what I call, it's done in a highly bizarre, indirect way. And that's just how it's done. It's required by accounting standards. And it ends up looking like this. And I don't know if this is ringing any bells for anybody. If the other great thing about Flex MBA is some of you just had intro financial, maybe like last semester, and others had it like 3 years ago. So it might be ringing bells for some more than others. Question, Evan?
Yeah, I was just, does somebody have like co-host abilities to keep people muted? Because I get very easily distracted. There's a lot. Your video keeps going away because other people's microphones are on.
Oh, okay. Let me find you. I can make you co-host. Sorry about that. I did not realize
I'll keep the airways clear.
it was. Well, let me try to find Evan Charles Moore. Oh, right. This is alphabetical by first name. Moore, make co-host. All right.
Thanks.
So you should be able to keep people muted. Thanks. I appreciate your service. And it didn't even occur to me to do that. I don't use Zoom that much, so apologies for that. Hope people weren't too distracted. Question from Sandeep.
Yes, sir. If I remember right, the gap rules talked about timings of all this. It had to be reported when it more applies to the two statements before the income statement and balance sheet. Could you just, I don't know, were you going to mention that? And
I wasn't, but I can talk about it real quick. So the way that the timing of these statements works, and I don't know if I'm getting your question exactly, or if I'm hitting what you were thinking about, but so we're thinking of all this stuff. Yeah, I didn't do a timeline here, but let's assume now all companies have 12-month fiscal periods, right? They can start and end the year whenever they want, as long as they keep it constant, right? So you could technically start in June and end in June, but I think of most companies, and it's the easy way to think about it, just assume the year starts on January 1st and the year ends on December 31st. And the way the statements work is the balance sheet gets reported right on December 31st. So whatever your cash on hand and your accounts receivable and your inventory and your debt, all that stuff, and you guys might remember the balance sheet is a snapshot, right? That's the kind of the cliche thing everyone says of a point in time on December 31st. The income statement and the cash flow statement represent flows that happened throughout the entire year from January 1st all the way to December 31st. So some of the sales revenue, some of the expenses, some of it happened in July, some of it happened in February. And the same is true of the cash flow statement. Some of those cash flows happened every day of the year. So I don't know if that was the timing that you were talking about, but essentially everything has to be contained within the January 1st to December 31st. But the balance sheet is just a snapshot of the very last day of that year. It doesn't tell us anything about what the assets were in July or February. It only tells us the assets, liabilities, and equity at the end of the year. Okay, Taylor, question?
Yeah, just a quick question. So I know that after COVID, like I've been reading up, a lot of companies are looking to have more cash on hand. That's kind of been the big push. Is that within this operating activity section? And I guess what causes the big push for that?
So, over time, I think investor appetites or like cultural, the way people feel about cash has changed. It changes dramatically over time. It kind of ebbs and flows. So like when I first came to Maryland, so I started out at UT Austin for a couple of years and the financial crisis had hit. And then the economic recovery started. And when I moved to Maryland and started teaching financial statement analysis, what I would tell students and what you would read in like the Wall Street Journal and the popular press was all these pissed off investors saying, why are all these companies, and they specifically would point to Apple and Google and say, why are these companies hoarding so much cash?
Yeah, yeah.
I want it paid out to me, the investor, right? Like if you're not doing anything
Mhm.
with it, give it to me. And we'll talk about that logic more when we get into our valuation models. But then, right, we have the flip side, like when COVID hit and all these companies, right? And I don't want to get into like, by the way, guys, I'm not political at all, despite the fact we're like in the DC area. I literally don't care about politics, but I kind of dislike all politicians. But the political environment that I observed, right, is that, well, now, all the poor companies need a handout, right? And so the government's like rescuing all these companies with COVID bailout funds. And at least I'm on Reddit a lot, so I read a lot of like what people are thinking, right? And all these threads like anti-work, and most Reddit threads were like, why the hell are we bailing out all these companies, right? They always tell us to save our money for a rainy day, right? Like there's no sympathy for the common person, but then why can't the companies save for a rainy day, right? And so now there's more of a push because of the recency of what's happened with COVID, I think, that, well, you've got to have a cash buffer, right? As a company, like
Okay.
to be
Got it.
safe. But again, the reason the companies didn't have a cash buffer is because all the investors were complaining for a whole decade about it, right? And so I think it goes like both ways.
It's a back and forth. Okay.
Yeah. And no one really knows what level of what level of buffer is optimal. But there is this idea. The theory says that if the company is going to keep cash, then it better have a value creating plan for that cash, right? Like they probably, like people are always talking about what Apple's next project is going to be with all this cash that it has, right? And hopefully they're going to invest it in something. Anyhow.
Okay. Thanks.
Yeah, that was a really long answer. Anyway, don't get me talking, right? Or I won't stop, I guess. Okay, so now where do we see that though? So where do we see the storage of too much cash, or I don't want to say too much, but where do we see the storage of cash? It's the cash account on the balance sheet. The cash account on the balance sheet, right? If that's 200 million or 50 billion, that's where we see how much cash the company stores. The cash flow statement tells us the change in that cash balance between December 31st of last year and December 31st of this year. So the cash flow statement can tell us if the company is storing up even more cash over time, or if it's burning through that cash over time. Okay. But so right here, we're just at the top of the cash flow statement, cash from operations. And the reason why it's kind of like a cash income statement, although it looks nothing like it, is because, gosh, it starts with net income. Okay. And then we're going to make all these adjustments. And then you guys might be having, if you are having flashbacks of this, it might be like PTSD flashbacks. Most people just absolutely hate this. But so we're going to start with net income. We're going to make all these adjustments. And then we're going to get, at the end of this section, we're going to get to cash from operations. Now, cash flow from operations is basically the cash net income. It's just that you can't find each individual line item here. You don't see cash revenue. You don't see cash expenses. You just see net income, all these seemingly random adjustments, and then cash from operations at the bottom. But I want to explain a little bit of the logic of what's going on here. Okay, this is very wordy, but you've got to think of the company as a complete moron, basically. Okay, and they're sitting there and they're like, how much cash did we get this year? And you're like, don't you know that, right? Like, why do you have all these accounting systems, right? But that's the weirdness of this method, because that's the logic behind it. They say, well, I've got my income statement, right? I've got my income statement. How much of it's cash? And then they use some logic. They go through the balance sheet and they say, well, if this account went up, that must mean I had less cash than I thought. If this account went up, that must mean I have more cash than I thought. And so they start making all these adjustments, and these are the adjustments, essentially, okay? They're adding, and this is why I talked about that logic, that, let me just go back real quick, this logic, that the change in cash is positively related to changes in liabilities and equity and negatively related to change in other assets. Those are the adjustments. Those are the adjustments that they're making to net income to get from net income down to what's the actual cash portion of it. Now, let me go through this in words, okay? And people will be crying when they're doing this usually. So I see net income, but how much of it's cash, right? And of course, the intelligent person says, well, let's go line by line down your income statement. Let's think about this, right? We start at the top. What's the first line on the income statement? Revenue, sales, right? Same thing, sales revenue. Says, well, you know, I see that sales revenue was $1 billion or whatever. Did we actually get that $1 billion all paid to us in cash? Oh, it's not so simple, okay? Where can we look to figure that out? We can look at the balance sheet. And the balance sheet has this account called accounts receivable, which is money that customers owe the company. So if accounts receivable, which by the way, right, is a non-cash asset. So if accounts receivable went up during the year, what does that mean? It means customers owe us more money. And what do they owe us money for? Well, they're customers. So they owe us money for the products they bought. So what that means is that sales revenue was not all paid in cash. Some of it was customers paying on credit, and that credit can be seen in accounts receivable. And so this is just one of like, right, 50 adjustments you have to make. But if we see accounts receivable go up, then we need to subtract that change, because it means that not all that revenue was received in cash, right? So we start out with $1 billion in revenue. Let's say accounts receivable went up by 100 million. So now we subtract 100 million and we're like, oh, 900 million was received in cash for that revenue. Let's go down one more line. What's below revenue? Typically, cost of goods sold. That's the cost of the inventory or the products that we actually sold, okay? So you see, well, we paid 500 million, or that's what it looks like from the income statement, right? We sold 500 million worth of inventory. And then you ask kind of the mirror image question from the reverse. You say, did we pay for all that inventory from our suppliers in cash? And the intelligent guy says, well, look, go to the balance sheet, look at accounts payable, because accounts payable is the money that the company owes to its suppliers. What do they owe money for? For the inventory that they got, okay? And so if accounts payable went up, it means the company owes the suppliers money, which means the company did not pay for all that cost of goods sold in cash. And so for this, we need to add it, because the income statement makes it look like the company spent 500 million on this inventory, but the company didn't actually spend all that in cash. They spent some of it on credit from suppliers, okay? So this is the logic of the cash flow statement operating section, where we start with net income. The company literally is like, oh, I have no idea how much of that is cash. And then we kind of go line by line through the balance sheet and figure out which assets and liabilities and equity accounts tell us about the differences in these numbers. And then if we make all the right adjustments, we will get from net income on an accrual basis, as we call it, down to cash flow from operations. Only the cash portion is remaining from that income. Okay, that's the logic. Now, I know I'm spending a lot of time on this. We're actually not going to do a whole lot with this, but we're going to look at some forecasted financial statements for Apple, and we are going to look at forecasted cash flow statements, and this is going to be there, and it's still very important that you get it right. If you don't get your cash flow statement right, there's not even a point in doing the valuation models, okay? So like the biggest single reason, remember I started this presentation saying that people for many years, and still today, and a lot of professors still teach it like this, that these valuation models don't give us the same valuation. And again, I'm arguing that the only reason they won't give you the same valuation is if you're making mistakes. And when I've literally seen probably 1,500 students come through and do a final project in my class where they do forecasting and valuation. 95% of the time, the reason their valuation models don't give them the same value is because they've made a mistake on the cash flow statement. So that's why I'm spending extra time talking about the cash flow logic. Yes, Evan.
So it sounds to me like, assuming everybody involved in the valuation process is competent, the only reason there should be a disagreement on valuation is we're going to argue about WACC or APV, those kind of
rates, long-term growth rates.
Everything else should come up to that point. You should be at the same spot.
Yeah, I mean, so I think most of the argument, so let's put it this way. None of the argument should come over which numbers get added and subtracted in determining like your cash flows each year. Okay. That the arguments would be on, and we'll look at this in a little bit, but and for those of you who haven't done forecasting ever, it's pretty standard to do like a 5-year out forecast and then have a 6th year with like a perpetuity on it. We'll get to this in a little bit, but essentially most of the disagreements come in the next 5 years forecasted financial statements. Like what is sales going to be next year, right? Tell me, right? Like what's Apple's sales going to be 3 years from now? Nobody knows, right? Analysts are trying to forecast it. Professional analysts don't even agree. So you kind of fight over that stuff, right? You get the sales, you get the growth for the next 5 years. Then you build the financial statements, and everyone has a different way of doing that. Some people, right? Some people think property, plant, equipment should grow with sales. Some people have different ideas, right? But then once you've got your financial statements and you make your statement of cash flows, all valuation models, if you put those numbers in correctly into the valuation models, you're going to get the same valuations. Okay. Yeah. Okay. So let's now look at the full statement of cash flows. This is a little crazy. Again, I made these just for this session. I may start using these in my class. I'm not sure. It depends on how they go over, but I tried this with arrows and it's just started looking insane. So I've color coded this. And then I was like, I know several people that are colorblind. and I was like, wait, let me try to pick enough colors so that like, hopefully even someone who's colorblind, unless you're just totally like insanely colorblind, hopefully you'll be able to see this. And if you are like just completely colorblind, I'm so sorry, but I just didn't know how else to do this. So we've got the balance sheet, and we already talked about this, right? The balance sheet, the operating assets, the investing assets. So we've gone over this. The only thing I've changed here is I now have Y1 and Y2 is year 1 and year 2. So I've got last year's balance sheet and then the current year's balance sheet, right? 2 years of balance sheets. And so we're looking at, right, there's a dollar value from last year, there's a dollar value from this year of cash. And of course, going from year 1 to year 2, that's the delta, right? That's the change in each of these accounts, okay? So over here on the right, I've got the 3 sections of the statement of cash flows. Operations, I'm omitting depreciation add back here. It's not important. That's for another time and place. So, so cash from operations, cash from investing, cash from financing. So what, and this is where just people make the biggest mistakes, because long story short, if you're forecasting financial statements and you're creating a statement of cash flows, every single account from your balance sheet must appear somewhere on the statement of cash flows. Everything has to be adjusted for. And this goes back to that equation from a few slides ago where delta cash is related to all the deltas of the liabilities, assets, and equity, okay? So I'm trying to color code where this stuff goes. So you let me know. So operating assets has now changed color, right, to be red. Where are we adjusting for the change in operating assets? Right up there in operations. We're subtracting. Remember, cash flows are negatively related to changes in assets. So we're subtracting the change in operating assets. Operating liabilities. I've also color-coded that red because we add changes in liabilities. Okay, that's from that original equation. So we're pretty much done with the operating section, right? Now, of course, a real company's balance sheet has like 50 items on it. So the trickier part is, okay, accounts receivable, inventories, accounts payable is finding all those little items and putting them in the right place. But that's why I've kind of simplified it here. I'm pre-assuming that we've kind of all placed the balance sheet accounts into the right items here. Then we've got investing assets. I've color-coded that blue. Where does investing assets go? Duh, cash from investing, right? You can almost just line up the terminology. So we're subtracting the change minus change in investing assets. And again, that's mostly like your property, plant, and equipment. It could be other investments like marketable securities. By the way, in your finance classes, that's typically when they're saying CapEx, capital expenditures, CapEx. CapEx in accounting terms is the cash from investing on the cash flow statement. Same, those two things should be equivalent, okay? Financing liabilities, I have color-coded yellow. I know this is starting to hurt our eyes. It's hurting my eyes, but financing liabilities, again, duh, they go in the financing section, okay? And so the financing section is all our debt and equity items, basically. So what's left is equity, right? Change in invested capital. So that's like our common stock. Okay. And we have two things that haven't been color coded yet on the cash flow statement. We've got net income at the very top, and we've got dividends. Or we'll get into why I call it ordinary dividends in a little bit, but you can just think of that as your, 25 cents a share dividend that the company declares. And then we've got one thing, well, other than cash itself. So cash itself does not get adjusted for on the cash flow statement. We'll get to that at the end. But so we've got retained earnings. So, I'm going to color retained earnings orange. And this goes back to that retained earnings equation that we talked about earlier, that retained earnings is a bucket, and the bucket, you deposit net income and you take out dividends every year. And so the change in retained earnings is equal to net income, right, that gets put into the bucket, and dividends that gets paid out of the bucket. And so I've color coded these things in. So net income is red, ordinary dividends is yellow, and there net income's at the top, at the very top of this whole thing. Ordinary dividends is at the very bottom. Okay. So what's happened here is every single thing on the balance sheet, the change in that item has been either added or subtracted somewhere on this cash flow statement. And even though you don't see retained earnings as a line item, you do see the components that change retained earnings. You see the net income and you see minus the dividends at the bottom. Okay. Now, what's the very last thing? So everything on the balance sheet has appeared on the cash flow statement except for cash. And guess what? Look what's at the bottom down here. Look what's at the bottom down here on the cash flow statement. It's the change in cash. So we only have one kind of thing left to close the whole loop, and that is the change in cash itself. So the cash flow statement, if Evan, go use the mute, so if you use the if you do the cash flow statement correctly, everything gets adjusted for. And so the most common errors that people make, and I don't just mean students, I mean me too, like when I'm doing a new forecast or something, the most common error I end up making is I forget to, I didn't subtract the change in accounts receivable, or whoops, I forgot to add the change in short-term debt down in the financing section. So the most common error is just to leave something out. The second most common error is to get the sign wrong, as dumb as it sounds, right? Subtract a change instead of adding it, right? And so you really have to keep track of your signs on these things. You look at all the assets. All the assets, you minus. All the liabilities, you plus. And then all the equity you plus, okay? So you got to keep your signs right. That's the next most common error, okay? But so basically this is the lot, and we'll look at a forecasted statement of cash flows for Apple in just a second here. Right now, actually. So let me try to share my, can you guys see the shared Excel file now? Okay, so I shared this with you guys, and I don't think I made changes. It doesn't really matter if I made changes, but I've got this as simple as possible, and you can see over here, I've already classified all the assets as either operating or investing, right? Apple's financial statements do not look this simple. I'll show you what they really look like in a second, but I've got the full set of financial statements here. And so what you do generally, and we're not going to do this in this session, but it's important to understand where this stuff comes from. So what you generally do, right, is you get the historical statements, which are the blue, okay, blue coded, and then you're forecasting what's going to happen in the future. And commonly we do this for the next 5 years, but for a company experiencing really steep growth, well, first of all, that's just hard to deal with in general, because who knows where that growth is going. But sometimes then people forecast out for 10 or 15 years. But 5 years is pretty typical. And I've got revenue, and then I do have a bunch of expenses, but they've been hidden for simplicity's sake. And I have net income down here. So pretty much, and don't ask where I got my growth rates. It's complicated. And I'm not saying this is like the holy grail. I'm not saying this properly values Apple, but mechanically, this is kind of how you do it. So you get your sales forecast, you have some expenses down there, you end up with net income, and then you get your balance sheet. And you can kind of see that the balance sheet items are all kind of growing slowly for the most part. You want to forecast down here. This is debt. I've got Apple's debt remaining constant. Why is that? Because when I look at their historic debt, I kind of just see it bouncing around. You know, it's kind of bouncing around. It's not obviously growing, whatever. So this, Evan, by the way, going back to Evan's question, this is the point where people start disagreeing on valuations. Like, no, I think the debt's going to double, you know, and then you end up with a very different value if that's your assumption. But anyway, these are my assumptions. Excuse me, I have chronic bronchitis. It's been going well so far, so hopefully it will continue to go well. So your first check is, see the total assets here, see the total liabilities and equity. Your first check that you typically do when you've done a forecast is to make sure that your forecasted assets are equal to your forecasted liabilities and equity. In other words, that your balance sheet balances. If your balance sheet doesn't balance, you have a problem, okay? The fundamental accounting equation must hold true. Now, the way I've done that here is I made all my different assumptions. And when you make all these different assumptions, well, debt's going to stay constant and property, plant, and equipment's going to grow with sales. You never get your balance sheet balancing. So what I've done is I've plugged the difference into cash. That may seem like it's not kosher, but it's actually extremely kosher. Plugging the difference in the balance sheet into cash is very typical. That's allowed my balance sheet to balance. All right. So we do the income statement, we do the balance sheet. Then we get down to everyone's favorite, the statement of cash flows. And again, this is where most people make the mistakes. I actually didn't even mention the biggest and most common mistake people make. And but then I don't even help the students. I just tell them to go back and redo everything. The biggest mistake you can make actually is going to the company's annual report or the company's financial statements, or even if you get on these online databases that have the financial statements, they'll copy and paste the company's historic cash flow statement into Excel. It's very common. In fact, it's so common that I think there must be a class at Maryland that teaches people to do that. And that is absolutely not what you do. Because if you pull up a company's cash flow statement, it's absurd. It's completely absurd. I mean, you see stuff like excess issuance of like stock options. And like, I mean, they have all these little minuscule accounts that only they can possibly know about. And only they know which balance sheet accounts those relate to. So, I mean, it's just an impossible task to try to forecast a company's statement of cash flows from its previous statement of cash flows. That might seem weird, but so we are going to end up, let me share my more complicated model real quick. I hope. Okay. So, Evan, you're the one I can see. Can you now see the cost of goods sold, revenues, and stuff like that? Okay, cool. So this is what it really looks like. This is from last year. So you can see this is from 2022, was in the future back when I made this. So I've collapsed all this into the nice, friendly, digestible spreadsheet we were just looking at, but moved forward a year. So you can see, like, I've got all these accounts, right? Okay. So I've got my net income. I forecasted all these balance sheet numbers, and you can see there's a lot, accounts receivable. But so what did I do to make it easy? I went through and I just said, well, accounts receivables operating, inventories are operating, this is operating. I basically just had to decide what's operating, what's investing, you know, what's financing and stuff like that. Okay, this is what the statement of cash flows looks like if you literally do it line by line. You start with your net income, and this net income is where does that come from? It's the net income that you just forecasted yourself up in the income statement. You just pull it down. That's what all this stuff is. You're just pulling these numbers, these adjustments down, and look what I've got. I've got all of these changes. Change. These are the changes in every single balance sheet account that I forecasted. And I am adding or subtracting, depending on whether it's an asset or a liability. I'm adding or subtracting every freaking change that happened during that year. And it gets me down to a net change in cash, okay? So this cash flow statement, by the way, if I go compare this to Apple's actual cash flow statement, it doesn't look that close. I mean, you should at least like ballpark it and eyeball it. For example, I've got Apple paying about $90 billion in dividends. I definitely would want to go back and look at Apple's previous cash flow statement and be like, did Apple pay? You know, is that what Apple's been paying? Right? And the answer is yes, it is. Okay. But again, this cash flow statement is created from scratch by you, or me in this case, the forecaster, and the cash flow statement is built off of the balance sheet and income statement that you forecasted, okay? Now, the balance sheet and income statement, however, look over here, right? Look at all the detail. The balance sheet and income statement is from the company's historic statements, okay? So I literally did copy and paste. I mean, I made a little adjustment here or there, but I copied and pasted Apple's income statement in here with all the line items. I copied and pasted Apple's balance sheet in here with all the line items. Okay, so that you do, but then the cash flow statement, you just make your own. And so that's the single biggest error people make. They don't make their own cash flow statement. They copy and paste the company's old statement, and they end up with essentially two different companies. Okay, because it's all fine and good. You've got a balance sheet and an income statement, but then if you flub up your cash flow statement, then you don't have the right numbers to put in your valuation model. Let's look at the chat here. How do you value a startup if they don't have historical data? Mildred, that's a great question, and that is way beyond the scope of this course. Yeah, well, I mean, short answer, how do they value startups? Have you guys ever seen Shark Tank? I don't know, like, so when companies don't have historic data and when their growth path is really unknown, so if you go take PE class with Pablo, that's probably correct. So a lot of it's based on comparables. So that's a whole other valuation method, but you'll hear people throw out rules of thumb like, you know, how many times sales should a company in this industry be valued at, right? So they'll use comparable ratio metrics and things like that, amongst other things. The other thing is, if you're a private investor that has significant influence over the company, like right, the company wants your $2 million, right, for their little mom and pop startup, you know, you can also demand that the company produce financial data for you, but it's inherently very uncertain for startups. So the stuff we're talking about here really is best applied to mature companies, and we'll get to that in a minute. When we get to the valuation, you'll see, you know, we're valuing publicly traded companies with publicly available data, and the way that we're going to then use that valuation is we're going to compare the valuation to what the current stock price is. So that's how you make investing decisions, right? You don't just kind of feel it out like, is Apple overpriced, or, you know, is that a good investment? Well, I don't know. You know, like, let's do the valuation and figure out what it's really worth, and then we'll decide whether it's a good idea to buy Apple right now or not. Okay, so that's kind of the logic here. Maybe, Elena, yeah, I just, you feel free to talk about this stuff, but I can't. This is the stuff we're talking about here is just totally different. Okay, so unfortunately, I don't have time to go into that. I do teach a class on, you know, using comparable valuation of companies without, and you don't really even have to dig into the financial statements at all, but it comes with its own pros because it's a little simpler, but cons because it's also highly uncertain. Okay, so let me go back to, hopefully the tech works, back to my PowerPoint. Okay, so anyway, again, we're not constructing cash flow statements here, but I just wanted to show you guys kind of where we're going to use those numbers that we just saw, the simplified versions. We're going to use those numbers in some valuation models. And so it's kind of important to see, okay, so these are based on a forecast. It's a cash flow statement that, like, I've created from the income statement and balance sheet that I also created, okay? But the last thing we're going to talk about right before we get to the valuation models is this concept called the cash flow life cycle. And Evan, just nod your head. Are we back to the PowerPoint? Can you see the PowerPoint now? Okay, great, awesome. So the cash flow life cycle, I guess really this is the product life cycle, but you can apply the life cycle. You can think of like the entire company as having a life cycle, right? So the companies have individual products, but also companies startup, right? You can think of introduction as startup phase, and then you hope, right? A lot of companies just fail almost immediately. I mean, I know people who work in startups, you know, they go from driving a $100,000 BMW to like sleeping on their friend's couch within 6 months. So a lot of startups fail, but you obviously hope that you get this like huge growth. And then at some point you reach maturity, right? Where you're a really big, successful company, but you've kind of exhausted your growth. And then the very sad time comes, just like with a human, that you go into decline, okay? And so the top line here is revenues. So just the sales, right? And this kind of goes to the logic of Shark Tank, right? Where the people that go on Shark Tank and ask for money, or the people that go to like look for venture capital and stuff, they're at the introduction phase. They're probably barely selling anything. Some of them literally are selling nothing, right? Because they're still developing the product or service that they're going to eventually sell. So in introduction, your revenues are really low. Then, of course, you hope you hit this explosive growth. That's what everybody hopes. And that's how we get rich, right? Or whatever. And then eventually, again, maturity and decline. All right, the next line is net income. What does net income look like? Well, it looks like exactly the same as the revenue curve, but shifted down a little bit. Well, what is it shifted down by? Why is it shifted down? Think about the net income is the bottom line of the income statement, right? Revenues is the top line of the income statement. What's in between those two on the income statement? All the expenses, right? The cost of goods sold and all the expenses. So net income is just revenues minus the expenses. So that's why the curve is just shifted down. And so you see in the early years of a company, sometimes even in the middle years of a company, right? I can't even remember how long Amazon took to actually make a profit. But I know when I was like in the late 90s, when I heard about Amazon, I was like, don't ever listen to me for investment advice, by the way. I was like, this company's going to be trash. I was like, a bookstore online is the dumbest thing I've ever heard, right? And then everyone was kind of poo-pooing Amazon for a long time, like, oh, they're still losing money. They're still losing money. They're still losing money. And it's kind of like 5 years later, just suddenly it was like, oh yeah, now they're worth $1 trillion. And all of a sudden they were making like big profits, right? So anyway, but in the early years, it's very typical to lose money. So you have negative net income, which we call a net loss. So then what does a company have to do, right? You can't just burn through money all day. Where are you getting the money, right? I know on Shark Tank, they're like, I remortgaged my parents' house for the third time or whatever. That's where they get their money. But in the real world, they get it from, and in the last set of lines here, and this is the most complicated ones, are our cash flows. And it's our 3 sections of our statement of cash flows that we talked about. It's our operating, our investing, and our financing, okay? And so let's talk about the operating curve first. The operating curve, right, this one, what does that look most similar to? It looks most similar. It looks pretty similar to net income, doesn't it? Right? It kind of follows the same trajectory as net income. Does that make any sense? Does that make any logical sense? Well, yeah, because remember, we just reviewed the cash flow statement. What is the operating section basically? It's like the cash version of income, right? So it should pretty closely mirror net income over time, okay? So again, just like the company has negative earnings, the company also has negative cash from operations in the early years. So it's burning through cash. Look at the investing activities. Investing, as we discussed, is mostly purchasing property, plant, and equipment, right? At least for most companies. And so what are the investing cash flows in the early years? Also negative. Gosh, even in the growth years, even more so, you know, it goes down and becomes even more negative, because how do companies grow? Well, they've got to buy more stores. They've got to open more manufacturing facilities. They've got to buy more delivery trucks, right? So the investing cash flows are negative for a long time. So companies are burning through all this cash, and who comes to save them? And I know most of you guys know the answer to this, but who comes to save them? Gosh, the financing people. And so our positive cash flow for most of the company's life is our financing cash flows. And what is that? What is a positive financing cash flow to a company? It's an increase in financing liabilities, or it's an increase in invested capital that we were just talking about. So either the company's getting bank loans, right, issuing debt, bonds, or they're issuing stock to shareholders, right? And they're getting shareholders' investment. And so shareholders' investment is keeping companies afloat throughout at least more than half of their existence, at least. But then what eventually happens when the company is in the decline phase? Look where the financing cash flows are then. The financing cash flows flip to negative. What does it mean when financing cash flows are negative? So the company is no longer taking on debt. The company is no longer selling stock. If the cash flows are negative, it means cash is leaving the company. So what is the company doing? It's repaying its debt. It's paying dividends or doing stock repurchases. It's sending the invested capital back out to the shareholders. Okay. This is the life cycle of a company. And so when we get into this valuation here, we're going to be talking about valuing companies. Well, we're going to be talking about valuing stocks, the stock of companies, the equity of the company, from the perspective of an investor. Okay. And so from the perspective of an investor, I'm looking at this life cycle here. And this over here, this tail of when I get money back is ultimately what I'm waiting for. I mean, it's all fine and good and like sexy and fun to buy a stock this month and hope that it shoots up next month, right? But investing really is about the long-term game plan of the company. The only reason you can sell the stock more next month is because somebody thinks that eventually there's going to be a big payoff from that company. And so we're talking about the end game here where the company actually starts sending cash back to investors. And you might be like, well, that's going to take forever. And that may be true, right? And managers might run the company into the ground before they're able to give back your investment. That also may be true. But if you look at an example like Apple, who was barely squeaking by, 25 years ago before they started coming out with all these cool products, Apple's been just paying out hundreds and hundreds of billions of dollars to investors over the last 10 years. And so that's just an example of eventually the money's got to come back to investors, and that's what investors are waiting for. And so we're going to get into some valuation models here in a second. And on the next slide, I believe, that tell us, well, then let's start looking at these payoffs and figure out how we can use that to calculate the value. Does anybody have questions before we proceed? Okay, I really hope that everyone hasn't gone to sleep. All right, so I know some of these sessions are like really fun. Like, we're going to talk about crypto, and I'm like here, and I'm like, let's do a bunch of equations. Okay, so intrinsic value. I can talk about crypto too, but if we get to it, I have a slide on GameStop at the very end. But that's a very small reward for a very long presentation. Okay, so when we're talking about valuation, we're talking about intrinsic value. Okay, good. Thank you for the vote of confidence, Ron. I really appreciate that. Okay, Ron said he's enjoying the session. Okay, so the intrinsic value of a company, and I'll touch more on this in a little bit, but what you've probably done, those of you who have touched on valuation, is you've done what you call a DCF. And a DCF, and again, I don't know, just like many of you have had different intro accounting professors, I would wager that many of you have had different finance or corporate finance professors. And I'm sure some of you have taken like another class on valuation or maybe applied equity analysis. But at the core, I believe what they teach in intro finance, or maybe finance 2 or whatever they call it, when you do a DCF, you may or may not know what you were doing, but I believe you were valuing the entire firm, the entire company. But when you value a company, you can really split it up into two components: the value of debt and the value of equity. And so somebody mentioned WACC, which is great. So if you were always talking about WACC, the weighted average cost of capital, then you were valuing the firm, okay? Because that's the weighted average of the cost of debt and the cost of equity. We're going to do something a lot easier. And well, okay, it might not be easy, but we're just going to focus on the equity piece, okay? And you might be like, oh no, but like, what about the debt? Like, you're shortchanging us here. The debt part's actually a lot easier. The debt cash flows are very easy to forecast. It's just the interest payment on the debt. And the debt interest rate, we know what it is. If we like go to the footnotes, we know the company has 6% bonds or whatever, okay? So, and then so if you wanted to value the whole firm, you can take what you learned today about valuing equity, and then you can just do the present value of future interest payments valued at the cost of debt. So, right. And so you add those two things together. And in theory, again, that assumes you've done everything correctly. In theory, that should then match up with your DCF for the whole firm using the weighted average cost of capital. But today we're just going to talk about equity, because that's really the hard part, or that's like the uncertain part, right? Like, I know $1 million in bonds are worth $1 million. I'm far less certain that $1 million of stock that I bought is actually worth $1 million. Okay, so that's kind of why we're focusing more on equity. Now, the intrinsic value. What do we mean by intrinsic value? It's like the deep inside, right? The underlying value means what something's really worth. So some of these terms can get confusing, right? Because you can go look at like what we call the market capitalization or the market cap, but some people just call that the market value. And that's just the total amount of the company's stock that's outstanding. It's the value of the stock right now as the market is valuing the stock. But the intrinsic value might be different, right? Might be lower or higher. And so and this is a big, right? This is a big challenge for us because we're basically supposed to put our thinking cap on and be like the guru and have a crystal ball and be like, no, the market's wrong, right? The value of Apple is not $179. It's $300, right? Or it's zero. And so it's very difficult, but that's what we're trying to do here. The true value, correct, Evan, the true value. Exactly. The true value is assessed by you, which is really funny, right? It's like, yeah, I know what it is. I got the true value here, you idiots, right? So, okay. So very, very brief and simple finance review, but I just know that some people, I've taught many student populations before, and we always get people that are like, I'm so scared of numbers. And like, I'm a marketing person, right? So I just want to just briefly review some very simple finance stuff. So we're going to have to present value this stuff because we're looking at the future, right? We're looking at future cash flows. And so this is just basic present value, right? If you want to present value something, it's just whatever that cash flow or that payment is divided by 1 plus the discount rate. This is very generic, right? R is just a generic discount rate right now. And then raised to the exponent of the number of periods, right? So N is the number of periods or the number of years. Everything here we're doing is in years. So the number of years, right? And so let's just real quick. And I know like half the people are like, oh God, but this will be quick. So what's the present value of $100 to be received 2 years from now at a discount rate of 0.11? Okay. So how do we do that? So the present value of $100 to be received 2 years from now at a discount rate of 11%. And so we do 1 plus 11, right? So it's like 1 plus 0.11 raised to the second power. And now I just realized that in my solution that I have here, I did not put the right thing in. So hold on, let me just do this real quick. 1.11, somebody else probably cranked their calculator out faster than me. Oh, no, I do have the right solution. Never mind. So that equals 8116. Okay. So we're just doing that math problem, present value, pretty simple. If it was 3 periods out, we would have an exponent of 3, right? So pretty simple present value problem. Okay. We're going to keep layering complexity on here. Like we're going to step this up, one after the other. So, all right. So the other thing, again, very basic finance. I think you probably covered this in the first finance class. This is just going to talk very briefly about beta and the concept of stock risk and the cost of equity, cost of capital for stocks. So, and this is important because this logic, right? You might be like, oh, beta, I know all about that and beta, but the logic of the cost of equity is going to come back, especially in our third valuation model. We're going to rely a lot on this logic. So I have to review this too. So basically, when we're determining the discount rate, any discount rate, right, there's 2 elements of it. There's the time value of money, and then there's the risk part of it. And the time value of money, well, time value of money is really coming in a big way recently. This used to be almost no part of a discount rate for most of the years that I taught. You know why? Because the Federal Reserve set interest rates at like 0 for so many years. And so the time value of money was like nothing, basically. But now with inflation ticking up and then now they're raising interest rates, time value of money is significant, right? Like I'm earning 4% on my friggin' savings account right now, right? But most of the time I taught this class, it was like treasury bills were like 0%. So time value of money is just like, look, money's worth more today than it is tomorrow. Sadly, very true these days, right? And then you've got risk. And the risk is, right, I give you my money and you go belly up, right? Your company collapses, right? So the risk is how volatile the payments, the future payoff is expected to be. And in terms of stocks, and this may ring a bell for you guys, again, I know some of you must have had this 3 years ago, but our beautiful capital asset pricing model, also known as the CAP-M, okay? The CAP-M just has a few components to it. And ultimately it's, I don't even have I do have it here, but it's not very clear. So RE is the cost of equity. also known as the expected rate of return on equity. But anyway, it's what you expect this company to return, this stock to return based on how risky the stock is. And there are three components to calculate the cost of equity, R sub E. There's the risk-free rate, RF, and then we're going to add the stock-specific risk, which is the overall stock market risk, which is the excess return on the market. So RM is the return on the stock market. RF is the risk-free rate, the government treasury return, usually. And then beta is how volatile your company's stock is. So, and I've got this on this page. So the risk-free rate, frequently people use, I mean, no one knows for sure, but frequently people use the return or the yield on 10-year treasury bills. You can just Google that. The government website tracks it daily. Then you've got this market risk premium, which is the additional return people expect just in investing in the stock market in general. And so this is the overall market return minus the risk-free rate, so the risk premium. And then that amount is that market risk premium is going to be magnified by your company's beta. Okay, so every company has the same risk-free rate in their model. Every company has the same market risk premium in their model, but every company has its own beta. And beta is how much your company's stock swings along with the market. So the more your company's stock swings when the market moves, the higher the beta is. And you can see in the model, right? You multiply the market risk premium by beta. And so it's like this multiplicative effect that dramatically increases your company's cost of equity. Okay. And so how do we interpret beta? Almost everything has a beta above zero. I mean, there are very few stocks that have a negative beta. That means that the companies, when the market goes up, when the stock market's up, if you have a negative beta, that means your company goes down. Almost nothing is like counter cyclical like that. Not even like gold and stuff like that. So most companies, and frankly, most companies will have a beta between like 0.2 and 3. Okay. I mean, you see a lot of betas, especially for mature companies, right around 1. And a beta of 1 means that when the market goes up 5%, your company's stock goes up 5%. When the market goes down 5%, your company's stock goes down 5%. That's a beta of 1. A beta of 2 means that your company's stock swings at twice the rate of the market. And so that would be much more risky, as you can imagine. Crypto may have a negative beta. I haven't checked, but yeah, crypto may move inversely to the stock market. Although I've heard that Bitcoin, at least for a large portion of Bitcoin's history, well, at least over the last few years, I've heard that Bitcoin was pretty closely tracking NASDAQ tech stocks for a long time. So it was kind of like Bitcoin was tracking other tech stocks, but I don't know about Dogecoin and Luna and all that. I mean, some of this stuff might have a negative beta. Interestingly, you know what technically has a negative beta over the recent couple years? GameStop. That's not a good thing. I mean, sometimes people are like, oh, negative beta assets is great because I can hedge the stock market, right? But what's happened with GameStop is it's so disconnected from like the fundamentals, right? That's just not what's driving investors in GameStop. It's so disconnected from the fundamentals that it's basically just like totally unrelated to what goes on in the stock market. So it's somewhere between a beta of 0 and maybe even slightly negative, but that is not normal, okay? Just to let you know. So anyway, and we're not going to get too much into beta. This is basically it. But the point is just this. The key point, the key takeaway is we're going to be using in all of our valuation models, we're going to be using the cost of equity as the discount rate because we are valuing equity. We're valuing the company's stock. And the finance theory says that this model is the appropriate model for figuring out what that discount rate should be. And it's based on the general riskiness of the stock market, the time value of money, and then that beta risk of the price volatility. All right. So we're going to use that discount rate in all of our, someone's saying, is beta, Taylor's asking, is beta used as the basis for identifying aggressive high risk portfolios in terms of 401k? You know, every stock index, you know, whether it's passively managed or actively managed, people use different definitions of what they're looking at. I mean, some traditionally what you would call riskier funds are more like what you would call growth firms, which tend to be smaller firms that have this really high growth trajectory, but because they're younger, smaller, and high growth, they're also more uncertain. And so you're like, well, they could go belly up in a couple of years, or they could, their products could fail. And, unlike a very mature firm that's kind of done growing, but they have a very reliable cash flow. And so, it's not as risky. But certainly beta does tend to be related to those type of characteristics as well. So I could definitely imagine certainly some investors love to load up on high beta stocks, right? Like they're like, give me more risk. Like I'm ready for it, right? Yes, Evan's correct. Beta is basically stock price volatility. And some people love volatility. Economic theory says people don't like volatility, and that's what this model's based on, right? So the higher the volatility, right, the higher the beta, the higher the cost of the equity, or the higher the rate of return that I, the investor, expect. Okay. Now we're not going to get too much. That's the risk side of things. We're not going to get too much into the risk this time. The key again here is that the R sub E, cost of equity, that's the required rate of return. And that's what we're going to discount all of our future cash flows or dividends or whatever. That's what we're going to use as our discount rate. Okay. Okay. Finally, after like an hour and 15 minutes, actually this is about the speed I think we should be going at. So let me just stop to look at some comments here. Going through finance 2. So they do call it finance 2. One step we take in finding the discount rate is unlevering the equity beta. Let's not get into unlevering the beta. Sorry, I don't have time to talk about that, but I will tell you this. I will just say this real quick, and it's not a good thing. The capital asset pricing model, the whole concept of beta, doesn't really work that well in predicting stock returns, right? Like the theory says that CAPM should predict stock returns, and in reality, going back to like the 70s, like if I do a research paper and I'm trying to like estimate stock returns, and or I have some strategy to like earn a return on stocks, yeah, you should control for beta, but other factors do a much better job explaining risk, and we're still not sure why. And so the reason we teach CAPM, the reason we even teach this is because it's easy. Right, I can look this stuff up on the internet and I can plug it into this model. The other methods require like having a big data set and having these risk factors that you estimate, and it's kind of crazy. But so I really don't want to get too much into beta. The point is that R sub E, right, the cost of equity, however you determine it, right, whether you use the capital asset pricing model, whether you're going to do some kind of unlevered beta, whether you're going to use other market risk factors that they've identified in research, you're going to, at the end of the day, have a cost of equity, and we're going to apply that cost of equity equivalently across all these valuation models. But I do totally agree. Even though like the cash flows, I talked about, you got to get your cash flow statement right? And like, you've got to get your forecast of your sales growth and all that stuff. You've got to get that right. You've got to be very comfortable with that. On the flip side, the discount rate really matters. Like the discount rate, if your discount rate is wrong, it'll really throw your valuation off. Okay. Like I rounded some of those numbers. Like I rounded my long-term growth from the spreadsheet. So in the spreadsheet, don't go look at it now, but in the spreadsheet, I assumed that Apple's long-term growth is going to be 6.2%. Where did I get that? That is the nominal GDP growth rate most recently. Okay. So I just assume Apple's going to grow along with GDP, which is a pretty common assumption. Okay. And where did I get Apple's cost of equity for that spreadsheet? Well, that's a little complex, but I use the beta. I use the beta from Yahoo Finance. I use the Treasury bill return whenever I made the spreadsheet for the risk-free rate. And then I get the market risk premium from this professor's website at NYU. Not necessarily the best place, but that's what I got. And so anyway, my cost of equity ended up being something like 9.78%. On these slides, I'm just slightly rounding those. I rounded my cost of equity to 10%, and I rounded the growth rate to 6% because it's easier for us to use on these slides, right? And that results in like a 10% decrease in Apple's valuation, right? Just those little, tenths of a percent rounding reduces Apple's valuation by 10%. So it clearly, that's in another part of this puzzle that's very important, but like guys, I'm an accounting guy. Like I'm going to show you how to get the accounting numbers into these things. If you want to get your discount rate, there's entire hedge funds and like investing firms where their whole thing is trying to get a better discount rate, like trying to figure that out better. And that's how they're going to arbitrage the market. Okay. So I'm just showing you one side of this. The other side, you can get into more advanced finance classes. All right. So our first model is the dividend discount model. Unsurprisingly, gosh, it's going to value dividends. Okay. Or at least what we call dividends. And so this model just assumes that the value of a stock today is the present value of all the future dividend payments. Okay. Now, one little caveat here is that we're going to have to expand our logic, and I'll get into detail in a second, that dividends aren't just that old traditional, and this is why I called them on a previous slide, ordinary dividends. They're not just, hey, 25 cents per share dividend declared and paid, right? It's actually any cash transaction between the company and the equity holders. Okay. And we'll talk about that in a second. So this is the mathematical form of the model. This is the mathematical form of pretty much every valuation model. It's just that remember that IV, the intrinsic value? The intrinsic value today, which is times zero, we're at times zero here, is the present value of all these future dividend payments, right? So D1 means the dividend at the end of year one, D2 is the dividend at the end of year two, right? And then we're present valuing these guys, right? Using the cost of equity that we just talked about. And so you got, discounting at 2 periods, 3 periods, 4 periods, ... Because technically we got to go all the way out. We got to go to dividend at year 256. Okay. Which is wild. I mean, how are we going to do that? Right. So how do we discount dividends at year 100? Are we going to have 100 terms in this model? No, we're going to do a shortcut that you guys may or may not remember from finance called a perpetuity. And a perpetuity, it's a very simple formula that deals with if you have the same cash flow. Well, everyone probably remembers an annuity, right? An annuity is like the same cash payment every year for a certain number of years. A lot of old people like that, right? They convert, I don't know why, but they convert their mortgage to like an annuity payment or whatever for the rest of their life. A perpetuity, perpetual just means continuous, forever, right? A perpetuity is just an annuity forever. And so we're going to have to make that shortcut assumption because we're not going to write 365 dividend payments or 1 million dividend payments. At some point, we've got to make a simplifying assumption. And so we're going to use actually what we call an increasing perpetuity or a perpetuity with growth. This is also sometimes referred to as the Gordon growth model. And what it assumes is that at some point in the future, right, because we can't keep forecasting. You saw my financial statements that I forecasted, right? I had 5 years of forecasted financial statements. And then I'm like, I'm done, right? I'm not doing this for year 15. So this is going to assume that the financials, not just dividends, but the entire financial statements, the financial statements stabilize after some certain year. In my case, it's year 6 that they stabilize. And so after the 5th year, as of year 6, everything's going to hit this smooth, constant growth rate forever. And the nice thing about that assumption, although it may not be entirely true, is that we can consolidate all those future dividend payments and calculate them just using this perpetuity formula. And so if I have a stream of dividends, and I know that stream of dividends grows at the same rate every year, like at 3%, then I can just do this one simple calculation and get the intrinsic value today. As long as I know the dividend next year, right, the first dividend in the stream, I just divide by the cost of equity minus that growth rate, that constant growth rate, and that's going to give me the answer. Okay, and we'll see that in action in a second. Okay, because that's going to save us a lot of time. And so again, I told you we're going to keep adding layers of complexity onto this. And so here's the first layer of complexity. Let's use a simple example where we are given a very simple dividend number that a company's paying, and let's present value these things, and let's use a perpetuity with growth. Okay. So let's do that. So Eastern Company has an expected dividend for the next 2 years of $1.50, followed by a dividend of $2.25 in the 3rd year, $2.75 in the 4th year, and then a growth rate of 5% per year thereafter. The cost of equity capital is estimated at 10%, right? So I'm using nice round numbers, obviously, because it's easier to write down and compute. Okay, so I want to know what the intrinsic value at time 0, right? IV0 is equal to. Well, in simplest terms, it's equal to the present value of those future dividends. So how do we do that? So the first year dividend is 150, right? And that's a year from now. So we have to present value that back. 1 plus the cost of equity, 1 plus 10% or 1.1, right? We're going to divide by 1.1 to present value that. 2 years from now, it was also, right? The first 2 years were both $1.50. 2 years from now, 1.1 squared, right? 3 years from now, the dividend's going up. That's always good when dividends go up. But we're going to discount it by 1.1 cubed, right? Then, and we keep going on forever and ever, except thankfully we've been given a simplifying assumption, right? That in year 4, and I'm going to write this up a little bit higher. You'll see why in a second. In year 4, it's going to be 275. But thankfully, we know it's going to grow constantly at 5% every year. And so this is this equation back here, the Gordon growth model that we're going to insert here. So I know that the first dividend in this stream is 275. I know what the cost of equity is. That was given up here, 10%. I know what the constant growth rate is. That was also given to us at 5%. So I'm going to do 0.1 minus 0.05, the cost of equity minus the growth. That captures all the future dividends out to infinity for the rest of time in that one term, okay? Now, that's great, but that's still not discounted back to time 0, okay? Because let's check out these terms. Check out these terms here. Actually, let me erase some of this junk here so I can then make a different point. Okay, so check out the terms. The intrinsic value, oh, my pen changed color. The intrinsic value at time 0, right, is equal to the first dividend in the stream at time 1, right? So when I do this perpetuity formula on a dividend that starts at time, or that is paid out 1 year from now, this formula present values that stream as of today, as of year 0, so 1 year before. What do I have over here? The last term in this model is the 4th year dividend, right? It's the dividend in year 4 that starts that stream, okay? So what would a dividend at year 4 be equivalent to, right? If I had D4 there over RE minus G, that would intrinsic value that guy by year 3, right? That's how subscripts in time works, right? If D1 gets you to IV0, then D4 gets you to IV3 in the 3rd year. So what I've written there in that 4th term is the present value of the perpetuity as of 3 years from now, which means I need to further discount that back by another 3 years. By the way, this is another place where a lot of people make a mistake in the valuation model because they just naturally assume that they've got to do 4 years because that's the 4th year term, right? And so, then you've dramatically changed your valuation if you just did that, okay? Does anybody have questions about that? Okay, so if you math this out, assuming I didn't make any mistakes, which is a big if, because I'm prone to do that. But anyway, you'll get the general gist of it. And I think these are right. It's funny. I double, triple check. I teach stuff for a few years. Some stuff a decade later, I figure out the last 10 years I've had a number wrong in my slides. Okay. And I just built these numbers for today, so God knows how many errors there are. But so the intrinsic value of this company, right? This could be a real company. It could, that paid dividends like this. The intrinsic value of this stock, I'm assuming this is one share of stock because a whole company doesn't pay out $1.50 to all the investors, right? So a share of this stock is worth $45.61. What do we notice? Just kind of eyeballing these numbers. What do we notice about these numbers? What does anything look kind of sketchy here? And I mean, maybe that's too broad of a question. Does anything sit kind of uneasy with you about this valuation? No, maybe it's fine. Everything's good. I mean, so I'll tell you what sits uneasy with me, although it's just life with valuation. What sits uneasy with me is that the next 3 years of dividends, I mean, I have a 3-year-old kid. One of my kids is 3 years old. In my mind, it's been a long ass time since that kid was born. Okay. The 3 years of dividends contributes almost nothing, contributes very little to the company's intrinsic value, right? Where's all that intrinsic value pretty much coming from? It's coming from the perpetuity, right? And maybe that's obvious because you're like, well, yeah, duh, right? Like the perpetuity goes out to infinity. So like, no, of course that's going to be a big part of it. But that's kind of always how valuation is, where the perpetuity, these numbers that are way out there in the future that are very hard to predict, is a huge percentage of the valuation. So what does that mean? It means if you get that first dividend wrong, or you get, this is even more common, right? You get the growth rate wrong, or you get the cost of equity wrong, you can have a huge impact on your valuation because that perpetuity just shifts so massively, okay? Anyway, just a caveat to think about with all, and this is true of all valuation, so it is what it is. But okay, so this is a very simple example of dividend discount. Now we're going to get into the financial statements and the accounting numbers and talk about how to really do this. So does anyone have questions about, this is just kind of the simple logic of how it works. Questions? Okay. All right. So now let's talk about the financial statements finally and how they actually play into dividends. Because a lot of people do this wrong. I even know some professors who basically teach, gosh, you know what goes into the dividend discount model? This, and they're done. Ordinary dividends, 25 cents per share. Well, guess what? If that's what goes into your dividend model, then you're definitely not going to get your valuation models to give you the same results, because that's not all that goes into the dividends, okay? The dividends are any cash transaction with shareholders. And what that means is if the company issues stock or the company repurchases shares of stock, those are also dividend transactions, okay? Now let's talk about share repurchases first. I know this has been a political hot topic for some reason with Democrats recently. They just hate share repurchases. In the framework of a dividend model, ordinary dividends and share repurchases are the same thing. It's cash into shareholders' pockets the same way. So if a company pays $10 million in dividends versus a company repurchases $10 million of stock, under the framework of the dividend model, same thing. That's $10 million of payouts to investors that we're going to present value. Now, the weirder one, I guess, is stock issuances, right? This is the company, and companies do this, right? GameStop just issued another 1.6 billion of stock a year or two ago, okay? So companies might issue more stock at any point. It's a negative dividend. And that kind of twists some people's brains sometimes, right? Because if any cash going from the company to the shareholder is a dividend, then if I'm taking more cash from shareholders, that's a negative dividend. And that's what a stock issuance is. The company is giving you more shares of stock and they're taking more of your money away. So we need to look at all three of these transactions and kind of sum them up, the positive and the negative. And that's going to give us the DDM dividends, a DDM dividend discount model. And I have to distinguish between DDM dividends and those ordinary dividends, because those are, as you see now, different things, okay? So this is all transactions with shareholders, all right? So this is, math-wise, this is how we do it. We take the ordinary dividends received. Now remember, this is important because we're an investor. I'm an investor, I'm outside the company, I'm valuing this stock. So I want to look at how many dividends I'm expected to receive, right? So how many dividends do I receive? Then I'm going to add stock repurchases because that's the same as a dividend. Still cash in my pocket, so I'm good. And then I'm going to subtract any stock issuances because you're taking cash out of my pocket and putting it into the company. And so when you do that math, you end up with the total dividends that the company is going to pay. Okay, does anybody have questions about this? Because now we're gonna do the numbers from the forecasts. Okay, so break has ended. Hopefully everyone's back. And I had a great question from Chris just now. We had been talking a little bit during the break about what do we mean by dividends and negative dividends? Because we were talking about how stock issuances are subtracted in this model because the company is getting cash from investors rather than vice versa. And then Chris's question was, rather than talking about stock issuances, he's talking about the stock repurchases and how that's confusing, which I agree, because it's not exactly the same. To me, the investor, like if I own a share of stock, right, and the company pays an ordinary dividend of 10 cents per share, right, that's 10 cents that directly goes into my pocket. Okay. A stock repurchase, by definition, right, because the company's not repurchasing everybody's stock or it wouldn't be a public company anymore, right? They're only repurchasing stocks from some subset of investors. Okay. But the same amount of total cash is still leaving the company, right? So the company could pay 10 million in dividends, spread it amongst everybody, or they could repurchase $10 million of stock. And of course, then they would only repurchase a subset of investors' shares. Okay. But just think about it this way first. From the perspective of the valuation of all the stock, the aggregate cash flows are still the same. Okay, so the same $10 million has still gone out to investors. Now, here's the point of confusion. And it's a little hard to explain, and I don't have time to make a drawing of it. But essentially what's happening, right? Yes, it is true what Chris said, that only a subset of investors actually immediately pocket that money. But then what's happening is there are now fewer shares outstanding, which means any future dividend payments are now spread amongst fewer investors. So, and again, this is just what the theory says. So it doesn't matter if I'm an investor in a company, it doesn't matter if they repurchased my share or not. I now have a bigger claim on future dividends. So my value is still increased by that stock repurchase. Now, maybe also what Chris meant is, where's the return, right? Dividends are a form of return, whereas a stock repurchase is a return of capital. But, and we haven't even really gotten fully into our dividend model yet, but let's just go back real quick to the dividend model. What does the dividend model say? It says the value of the stock today is worth all the future dividends. So when the company repurchases an entire share of stock, again, according to the theory, what is the company surrendering to the investor? They're surrendering the present value of all the future dividends. That's the idea. So a stock repurchase, it's true, it's not an ordinary dividend, but it is in fact, they're giving you back the present value of all the future dividends you would otherwise receive if you continued to own the stock. Okay, I know, I told you we have to go through this a little bit quickly, but this is, I'm trying to unwrap the confusion a little bit by saying all investors benefit when a company repurchases stock because now there's fewer shares of stock outstanding. The investors who get their stock repurchased, it's true, they're not getting a single year dividend, but if the market is relatively properly valued, they are getting the value of all the other future dividends that they would otherwise receive. Okay. And then again, just if you just want to think about it simply, then I just like to think about it. And to anyone listening, if that explanation I just gave confuses you, then, you know, I just think about it, how much cash in aggregate is going out into investors' pockets. Like, let's not get too detailed and think about this investor versus that investor, and this guy got a dividend and this guy got a stock repurchase. Let's just think about cash going in or out of the company and going to or from investors. That's kind of what we're thinking about here. Any other questions? Let me mute this and cough. Okay. I never thought I would be in this position. I have an inhaler. Like I've been in great health all my life, and then this COVID stuff came. I kept getting sick. I didn't get COVID, but I kept getting sick from my kids over and over, and it's just never going to go away now. So now I have an inhaler for, like, I guess for the rest of my life. What a wonderful life. Okay. Anyway, things could be worse, right? All right. So maybe a question in chat. What other? Oh, that's a direct message to me. Nicholas asked, what other courses do I teach? Well, I used to teach financial statement analysis in this program, but they've been reducing the electives and my elective got cut. So I don't teach anything in this program right at this moment, although I do now teach introductory accounting. But so far I've only done it to full-time MBAs and MS students. But so they, they put us around where they need us, professors mostly, but I might eventually teach intro accounting to Flex MBA. Who knows what the future holds. Okay, so now here's this other method. And when I go through this right now, especially because we're going to see some equations here, your first reaction might be, oh my God, like, why do we need to learn another method for calculating dividends when, you just showed us this method? Why do we have to learn two different ways? And all I can say is just wait a little bit, because even though this slide right here might seem like a bit of a headache, it's going to help us avoid much bigger headaches in a little bit, in a few slides from now. Okay, so just bear with me here. Okay, so the indirect method, so the reason, first of all, the reason why this method is called the direct method is because these line items, dividends, stock repurchases, and stock issuances, can be seen directly on the cash flow statement. Okay, so we call it the direct method because it's like, what dividends did they pay? How much stock did they issue? Well, let's go look on the cash flow statement. We can directly see it. There's also an indirect method where we don't need any information from the cash flow statement at all, okay? And this relies again on the fact that the cash flow statement and balance sheet from like 10 slides ago, remember, technically the cash flow statement includes all the changes from the balance sheet, right? And so the fact that this is a kind of a closed loop system is what allows us to have two totally different ways to calculate the same number. And the indirect method doesn't use a statement of cash flows, but it does use income statement and balance sheet data. And so to start off, you may not recall this because you've just seen this lecture once. I've run through it a few times, or at least, I've eyeballed it a few times, but this was on the very first balance sheet slide from like maybe the third slide in this session, where I was trying to tell you guys that retained earnings is this bucket, right? And the retained earnings bucket collects net income and pays out ordinary dividends every year. So this is just a copy and paste of that equation, right? Retained earnings this year is retained earnings last year plus net income minus dividends. Now, all I'm going to do, well, for the first step is a little more sixth grade math, right? I'm going to move T minus 1 over to the other side, right? So now I've got RE, retained earnings at time T, minus retained earnings at T minus 1 equals net income over dividends, which in even more simplified terms is just this, right? Delta, change in retained earnings. So this is just the same old retained earnings equation that we have already seen and talked about a couple times. Changed in retained earnings equals net income minus ordinary dividends. Remember, we've now expanded our definition under the dividend discount model. We're now thinking about stock repurchases and stock issuances as well. So we have to distinguish between DDM dividends and the old school ordinary dividends, okay? Now, I can again flip sides, right? I can bring ordinary dividends to one side, retained earnings to the other side. And so now I have an indirect way to figure out how many ordinary dividends the company paid. If I know net income and I have a balance sheet and I know the change in retained earnings, right? Net income minus the change in retained earnings equals ordinary dividends. That's just math, right? From these equations above, that's just math. Now, I'm interested in much more than just the ordinary dividends because we're doing a dividend discount, again, that includes stock issuances and stock repurchases. And so if we want to expand that, and you just take me for granted on this, I promise you it's true. But it relies on the logic basically that the dividends we're thinking about now includes all the equity transactions, right? It includes everything that's changing in equity, the common stock, the ordinary dividends, everything. It changes to this. Instead of change in retained earnings equals net income minus ordinary dividends, if we think about all the different equity transactions now that we're thinking about, then we have this equation, that the change in equity on the balance sheet, right? All those equity accounts, common stock, retained earnings, equals net income minus the dividend discount model dividends that we were just talking about. And again, we can flip the side of the equation just like above. And so ultimately, right, because this is for our valuation model. For our valuation model, we're present valuing the dividend discount model dividends. And so this indirect method here, I can also figure out what each year's dividends are if I know these two things. Net income minus the change in total equity, right? The total equity on the balance sheet. then I can calculate DDM dividends. So there's two ways to do this. One is look at the cash flow statement, find the ordinary dividends paid, find the stock issuances, find the stock repurchases. That's the direct way. And then there's this indirect way. I don't need a cash flow statement at all. I just need to know what net income is, and I need the balance sheet equity for 2 years to calculate the change. And again, right now you're like, God, why do I have to learn these two methods? I hope to convince you in a minute why this is helpful. Okay. Any questions about this right now? We're going to do the numbers. Next slide, we're going to start doing some actual numbers. Okay. So maybe not next slide, the next slide after this. So I've already talked about this a little bit, but typically we can't just forecast financial statements forever. We've got to cut it off at some point. It's pretty common to use a 5-year set of financial statement forecasts and then switch over to that perpetuity with growth assumption in year 6 and beyond to deal with, year 6 to infinity for the whole rest of time. And as you saw from the Excel spreadsheet I flashed up earlier, that's what I've done. And that's where these numbers are pulled from. So in all our valuation models that we're going to do now, I'm pulling from the same spreadsheet that I showed you, right? I'm pulling all the data from the same set of financial statements. And so everything is consistent. And so if we do it right, we should get the same valuation no matter what we do. So let's try. So first we're going to do the direct method of dividends, okay? And the direct method of dividends is the ordinary dividends received. So I'll just say dividends received, but that's ordinary dividends. Dividends received. And then we need to subtract stock issuances and add stock repurchases. I've simplified it so much that I don't even have that. It is true that every year Apple repurchases stock and Apple issues stock as part of its stock compensation program. But all I have here is dividends and net stock issuance, okay? So if it's a positive number, right, what does this mean for Apple? This is Apple's cash flow statement, right? So if I see a positive 2, this is all in billions, by the way. If I see a positive 2 billion, that means Apple on a net basis has issued 2 billion more in stock. And that's a positive number because Apple took cash in from issuing stock. Okay, so Apple has an extra $2 billion now from shareholders. But then look at the dividends that it paid. It's also paid out to investors. And remember, in accounting terms, parentheses means a negative number, right? So it has a $94 billion negative or outflow to investors from dividends that it's paid. Okay, so I'm down here. I'm on the investor side. And I've got my dividends received, and I need to subtract any stock issuance. So I need to kind of flip my thinking, right, based on the company's cash flow statement compared to what I, the investor, am receiving. Okay, so if I do this, I'm going to get the DDM dividends.
Sorry, really quick, Professor.
Yeah.
For like 2025 is 4 for the net stock issuance. Is that saying 4 total for that year, or 2? Or like 4 additional only solely for that year?
So each of these years, so at the end of each year, like that year's done, and then the next year is like its own year. So this goes back. I should have had a timing slide like someone else asked at the very beginning.
Thanks.
At December 31st, actually for Apple, it's like October something, but at the end of each year, everything cuts off and then resets, at least for the income statement and statement of cash flows. The balance sheet is kind of, again, this snapshot that's like an ongoing snapshot that keeps existing. But the income statement and statement of cash flows just describes what happened within the boundaries of that calendar year. Does that make sense?
Yes, thank you.
Okay, cool. Nicholas, question?
Yeah, I'm just going back and looking at so I have the slides pulled up, even though you said for us not to look at them.
Do what you want to do, but I just hope that you have a version that I haven't made changes to. But yeah, go ahead.
So I'm looking at the formula for the DDM.
Yes.
And so with this example, we are assuming, obviously, it's intuitive, but we're assuming that no stock issuance, stock repurchase was done, right? Because we're not adding anything.
Well, here's what happened actually. Okay, so let me go back. Let me try to share my complex Apple spreadsheet. So can you see the spreadsheet now?
Yes.
Okay, cool. So even in the complex spreadsheet, I had actually already simplified things. So Apple issues some kind of, compared to its size, right? Compared to these other numbers, it issues some meager amount of common stock every year. And then it pays a massive amount of dividends. Now, what I did, just for simplicity's sake for me, now that as a teaching tool, this isn't very helpful because we're not seeing any stock repurchases in our model, but I have already collapsed ordinary dividends and stock repurchases into one item. So if you were to actually pull up Apple's actual cash flow statement that was like filed, publicly with the SEC, you'll see it's roughly if I recall, it's roughly a 50-50 split where they're both paying traditional ordinary dividends and they're repurchasing stock. And I have lumped that into one number here because I guess because I teach this and I already know those are theoretically the same thing. Does that answer the question? So they are repurchasing stock. I've just pre-classified it as dividends.
Okay. Thank you.
Okay. Yeah. Again, not helpful for pedagogical purposes because I'm showing you guys this and talking about stock repurchases and we're not seeing stock repurchases, but let's see. Okay. But they are there. But, companies have a whole mix. So you might, again, still go by the equation thank you for bringing this up, by the way, go by the equation that I showed, right? If you look for a company, if you look at any company's cash flow statement, you want to look for all three of those items. You want to look for ordinary dividends, you want to look for stock issuances, and you want to look for stock repurchases. Sometimes also called treasury stock or treasury stock purchases. Because you will need to include all those items. But here I've made it a little bit simpler for us. So, all right. So and everybody can see the PowerPoint now. Is that reshared now?
Yes.
Okay, great. Thank you. All right. So the numbers are pretty simple here. Okay. Now the key logic is, again, we're on the other side of this. And so these numbers are kind of going to get flipped. At least the dividends received is going to get flipped because look, from the company's perspective, it's the company's cash flow statement, right? So they're paying the dividends, but we're the investor, we're getting the dividends. Okay. And so note that dividends paid versus dividends received. And so how many dividends do I expect to receive in 2023? 77, right? That's a positive number to me, the investor. How much stock issuance? And again, the stock issuance numbers for Apple are positive, but that's why I'm subtracting it here because that would be a cash outflow from me. Now, there is no stock issuance forecast. Don't ask why. That's just how it turned out. Apple's forecasted to be pretty flat at the end of this year, so I just kept kind of a lot of stuff fairly constant. So that's it. So the DDM dividends for 2023 is 77. Okay. For 2024, I've got 94 in, again, as I just brought up, a combined, ordinary dividends plus stock repurchases, 94 billion. But Apple's forecasted to issue 2 billion of stock. And so that is a negative too. That has like a negative dividend effect. And so the total is 92. For 2025, we've got, right? And then once you kind of get the math, you just keep doing the same thing, right? For every year. Of course, if you were doing this in Excel, you just do Excel and you drag it over. But I find teaching with Excel to be it makes my eyes bleed. So that's why I'm kind of writing everything down instead of looking at all these little tiny Excel cells. So that ends up with 93. In 2026, we've got 99 minus 4, which gives us 95. And then in 2027, we've got 100 minus 3, which gives us 97. Okay. Now, by the way, it's just coincidental. It's just coincidental that most of the DDM dividends happen to match up with the cash from financing. It's just that I've made this so simple that nothing else is happening, right? I have Apple. Remember, I'm forecasting Apple's debt to remain constant. So there's no debt transactions other than in the first year. With that debt issuance, right, of that debt issuance of $4. So there's just nothing else happening with Apple. They're not taking bank loans. They're not repaying bank loans. So just then coincidentally, the DDM dividends are all that's there. That's all that's on the cash flow statement, basically, for most of these years. That generally won't be the case. As long as if a company's doing stuff with debt, then these numbers are not going to be equivalent. But that's how we do it. I mean, we just calculated the DDM dividends for Apple for the next 5 years. And we're not done yet because we still have year 6, the 6th year and beyond. And we're going to have to do a perpetuity thing. But does anyone have questions about this? Okay. So before we get to the perpetuity, let's try the indirect method. Because remember, we said the indirect method, we don't need any cash flow statement items, but we're supposed to get the same numbers, supposedly, right? So now I've just copied and pasted from those same forecasts, the net income that I forecasted and the balance sheet equity, okay? And so remember the indirect method, the dividend, the DDM dividend is equal to the net income minus the change in equity. So what have I had to do here? Notice that a new year, I had to paste last year because I can't know the change in equity if I don't know the previous year's equity, right? So even though we're forecasting going into the future, right, 2023, 2024, we need the equity in 2022 that's already happened so that I can calculate the change in the equity, okay? All right, so for this one, I've got the net income, and I'm going to subtract the change in equity every year. And that is going to give me, again, if I do it right, the DDM dividend, okay? So now I'm not going to quite line these up with the years or I'm going to run out of space. So I'm going to have to make my own years down here. But so for 2023, remember, we're not valuing 2022. That's only there so we have the equity number there. So for 2023, we've got the net income of 100, right? So I'm going to put $100 in net income, and I'm going to subtract the change in equity. What's the change in equity? It's the ending equity from 2023 minus the ending equity from 2022. Got it, right? That's the change in equity, right? It went up from 56 to 79. So if I subtract that change, right, that's what we're doing here. And so that's going to equal, if I do that, right? So I've got 100 minus 23, right? So that equals 77. For 2024, I've got 105 minus 92 minus 79 equals 92. See what's happening? Each year we have to roll forward, right? So it's like I'm always having to compare. I'm always having to take the income minus the change in the equity for those years, right? See what's happening? Every year I grab the income and then the change in equity. So for 2025, I've got 108. Now I'm confusing myself. I've drawn too many errors. 108 minus 107 minus 92, which is 93. Now I'm going to stop here because look what's happening. What did we get with the direct method? We got 77, 92, and 93. What are we getting with the indirect method? 77, 92, and 93. So I promise you the next 2 years also give you the same result. And so the first takeaway here is direct method dividends, indirect method dividends, you're going to get the same numbers. So just accept that. Let's not continue calculating here. Again, though, that's just for the first 5 years of the model. Then we need to know what we're going to do after year 5. So generally, the terminology is that the 5th year is called the terminal year. And then the year 6 and beyond is what we call steady state. And it's called steady because it grows at a steady growth rate. And that should key you into, oh, it's going to be a perpetuity with growth. Okay. What should the growth rate be? Normally somewhere around the nominal GDP growth. So we expect companies over time to kind of grow with the entire economy. This makes it really hard to value high growth companies because 6 years from now, they're still going to be growing faster than the economy. But if you do a perpetuity out to like infinity, you can't have a company growing at like 15% for all time. They're going to literally like dominate the galaxy. Okay. Like it won't even work mathematically. So anyway, that's a challenge for high growth companies, but it is what it is. Okay. So this is why This is the main reason why we learned that indirect method, because it makes year 6 a lot simpler. And I'll show you why it's simpler in just a second. Okay, but for now, let's just do the indirect method. So first, we stopped forecasting, right? My forecast stopped in 2027. So we don't have a net income or an equity number for 2028. We don't have that, right? I threw my hands up in the air and I'm like, I'm done making financial statements, right? But we still need a starting dividend for that dividend stream. So what we're going to do is use the indirect method that we were just doing on the last slide. What do I need to calculate indirect method dividends? I need net income. I need a change in equity. Okay. So the first thing that I need to fill in is what's net income going to be for 2028? Well, remember, the assumption here is that the company is going to grow at a constant rate from now on. And I am assuming a 6% growth rate here. Okay. Again, going back to what Evan was saying earlier, this could be a big point of contention among people doing evaluation. What's the proper growth rate? Okay. But I'm assuming 6%. So how we do this is we apply that growth rate to get from 2027 to 2028. We apply that growth rate to the income statement and the balance sheet. In this case, luckily, we only have to do it to 2 numbers. So if I want to grow, right, I have the net income in 2027. I'm trying to get to 2028. What am I going to do? I'm going to multiply by 1.06, 1 plus the 6% growth rate, right? That's how we grow a number. So if you do that, you get like 111 times 1.06 is equal to, obviously I can't do this math on the fly, so it's 117.7. So that's it. That's how we get our income for the perpetuity, or the calculation for the perpetuity. We just multiply it by 1 plus the growth rate. Same thing with equity. Ending equity in 2028 is going to be 136 times 1.06, which ends up equaling, again, if I did my math right, I think I did, 144.2. Okay. All right. So now I can use the indirect method. So the indirect method, again, remember, we just did it on the other slide, is net income minus change in equity, right? Equals the DDM dividend. And we're now on our 6th year. So this is 2028 now that we're calculating this for. And we start off with the net income number we just calculated, 117.7. We subtract the change in equity, which is 144.2 minus 136. And that gives us roughly, I might have some rounding because I've rounded these numbers so much, $109.5 billion. So if we assume, based on my forecast, right, if we take those numbers, and our assumption now is that Apple's going to grow at 6% forever, then the first dividend in that dividend stream is going to be 109.5 billion in dividends. Okay. But we're not done. That's just the 2028 expected DDM dividend. The whole point of this slide is to take us all the way out to infinity. So we then need, right, to take us out. So we need a perpetuity with growth that we talked about earlier. Remember, we did this in the very simple dividend slide with the Eastern company with just 4 dividends, but we still have to do the same logic here. How do we do a perpetuity? We take the first, and we hopefully don't typo it here. Okay, we take the first dividend in the stream of 109.5, and we divide by the perpetuity with growth equation is cost of equity, 10%, 0.1, minus the growth rate of 6%, 0.06. Okay. And if that's the perpetuity, so if we do that, we get this massive, right? Just like in the simple example, we get this massive perpetuity. Okay. So this number here, 2737.5, that is the stream of dividends that Apple's going to pay from 2028 up through, the year 4,560, right? Which we may never get to, but that's what Apple's going to pay for the rest of all time. And just eyeball it, right? Eyeball it compared to the dividends we calculated here. It's like next year it's 77 billion, then it's 92 billion, then it's 93 billion, right? And then 2028 and beyond, is 2.7 trillion, right? So that's like the bulk of our value here. But it is what it is. So we still haven't present valued any of these things, right? Because we still need to bring this stuff back to today's dollars. But does anyone have questions about this before we do that? Okay. So again, I hope people aren't like sleeping or just like, they're just mind so blown that I hope people are generally following along. But I just want to show you something, because this can kind of seem a little bit like witchcraft. like wait, what we were looking at the cash flow statement, and then all of a sudden you have kind of this weird perpetuity that you're using. You're not even looking at the cash flow statement anymore. You're using this indirect method. And this also gets back to why we even learned the indirect method, because as you might think that the stuff we did on this slide seems like, wow, that's kind of a lot of calculations. Let me just show you real quick what you would have to do to use the direct method. And also, I think this is another reason a bunch of people mess up their valuation models and don't get the same result, because it really is really time consuming and difficult. And I'll show you, let me just show you. So I have to reshare my Apple spreadsheet. Okay. Again, we've seen this part before. We've seen the balance sheets that I forecasted. We've seen the cash flow statements that I forecasted. What we haven't seen is the valuation models, which are over here. And let's not dig in, but you see the numbers. I mean, with some rounding, right? I have a little bit more rounding in the PowerPoint, but right, this is what we just calculated: 77, 92, 93, 95, right? So that's what we just calculated. We just calculated the 109.5. Now I said 2737. This goes back to, I didn't round my return and growth assumptions. I have cost of equity 9.8, growth rate 6.2. Just changing those to 10% and 6% changes the perpetuity from 3.04 billion to 2.7 billion. That's how big the effect is of rounding these growth rates and cost of equity rates. Okay, but anyway, I showed you just now the indirect method of getting the 109.5 to plug into the perpetuity. Let me show you over here to the very right. I have a, how will we do the direct method? Well, recall, the direct method requires a statement of cash flows that you can look at and see, oh, there's the dividends they paid. There's the stocks that they issued, right? Okay, the way that you have to do this. So you take your last year of your forecasted financial statements that was already over there. I've just pasted it over here so we can see it next to each other. We've got to grow every single income statement and balance sheet item at the steady state rate at 1.06. So look at my equation. I'm just taking equals last year times 1 plus the growth rate. So that's what I've done here. I've grown every single balance sheet and income statement item at 1 plus the growth rate. And here's the key, and this, people make mistakes, because what people tend to do is they just grow the cash flow statement at the steady state growth rate. It doesn't give you the same result. And I won't prove that to you here. You can monkey around with the spreadsheet if you want on your own time and prove to yourself that it's not the same. You've got to recalculate a statement of cash flows from these new balance sheet numbers, just like the previous statement of cash flows. And if you do that, you come down here and you get your, I call it change in invested capital, but that's stock issuance. You get your stock issuance and you get your dividends. And if you add those two things together, right, and flip the sign, it's 109.5. It's 109.5. But look what I had to do. 109.5 is what we just calculated on a little tiny PowerPoint slide with two numbers, right? To get that 109.5 using the direct method, I needed to do a whole nother set of financial statements grown at the steady state rate, calculate a whole nother set of statement of cash flows. So I just wanted to prove to you that they give you the same result. And I also wanted to kind of show you why, I prefer the indirect method for year 6, because gosh, doesn't this look simpler than doing a whole nother set of financial statements? And what I found the first few years I taught this stuff in financial statement analysis, I forced students to use the direct method and calculate a whole new statement of cash flows. And it was just so common that people did it wrong, that I was like, you know what? Let's just do the indirect method for year 6. And all of a sudden people started like not making mistakes anymore. So that's why we did that. All right. So question. Yes, Evan.
you may have said this before, I had to walk out of the room, but is there a benefit? Like if you have the time, is there a benefit to doing the direct method and constructing that?
In theory, the theory says the same thing as we just showed here, which is either method gives us the same numbers. And the thing is, you've already, for the first 5 years, you've already constructed a full set of financial statements. So you've done that. And so then the question is, are you going to create also a 6th year of financial statements that require you to use this growth rate to create them? And the answer of whether there's a benefit, the answer is no, because assuming you've done everything else correctly, because no matter how you do it, you should end up with that same, this same 109.5 down here, except the direct method has taken you a lot more time, and the direct method, or at least it's taken you a little bit more time, but the main thing that it's also done is it's giving you a number of places that you can make more mistakes, right? And so that's kind of the danger of using the direct method. Like if I did the direct method, I would always do the indirect method also, just to make sure I didn't make a mistake. And so it's like, well, then why not just do the indirect method, right? That's my perspective anyway. Okay, so we calculated all these dividends, but we have to present value them. And so we had 77 DDM dividend in the first year. I'm just copying and pasting basically what we calculated a few slides ago. Then 93, then 95, then 97, and then 2028, and the arrow means and then going out, right? Like ... forever. We had that massive perpetuity of 2737.5. Okay. Now we've got to discount all these back. Now it's just like a simple present value problem that we've already talked about. We're going to discount this by each, we're going to divide by 1 plus the discount rate. So I guess really this is more like a discount factor that I'm doing here, but it's 1.1 because it's 10% cost of equity, right? 1.1 squared, 1.1 cubed, 1.1 to the 4th power, 1.1 to the 5th power, and then be very careful because it's so like seductive to want to be like 1.1 to the 6th power. No, it's not. It's 1.1 to the 5th power again. And that power will make a big difference with such a large number to your valuation. And again, if you want to go back, I'm going to post this recording on YouTube, but the key here is that the perpetuity formula already brings this back by 1 year. So that 2737 is present valued as of 2027, even though the dividend stream starts in 2028. So you're always going to discount the perpetuity by the same number of periods as the year before. All right, so if you do this, you end up, and there's some rounding here, so not everything is perfectly accurate, but it's close enough to get the point across, hopefully. All right, so these are the discounted numbers. And then the value of Apple's equity. So if you just wanted to go look at Apple's current market cap, or if you want to call it market value, if you want to go look at that, we would compare it to this number. We're just going to sum all these guys up. We sum all these guys up, and we get 2040.8. So a little over $2 trillion is what, based on this valuation. And I'm pretty confident in my assumptions, actually, even though this looked like super simple and like dumb. Those assumptions that I developed were like pretty detailed. So Apple's worth about 2 trillion. But what are you going to do with that, right? Because most investors, you're like, should I buy the stock or not? And so you're usually looking at stock price. And so the final step here, if you want to bring this on like a per share level, is you divide by the shares outstanding. And I just go to Yahoo Finance for that. For that. This is another great place to make a mistake. You need to make sure all your numbers are in the same denomination. So the same, whatever it's called. If you're in billions, you want everything to be in billions. If you're in millions, you want everything to be in millions. These are all in billions right now, right? So this value of equity up here that I have, the 2040, that's 2,000 billion, or in other words, 2 trillion. And then my shares outstanding, Apple has 15.7 billion shares outstanding. So it's apples to apples, right? I'm dividing billions of dollars by billions of shares, and that gives us a value per share of $130 per share. I'm going to cough real quick. So the next step, How do we use a valuation? Well, I go look in the stock market and I see what the stock is trading for. And I told you I'm confident in my numbers. Feel free to totally think that my stuff is bullshit, because guess what Apple's trading at? Apple was trading at $179 per share, $179. So what is my valuation telling me? Let's assume I'm right. And just to be clear, I'm not going to go trade on this. Like, I'm not that confident in it, but let's assume I'm right. And I think Apple's value is 130. Apple's currently trading at 179. So what do I conclude about Apple's stock? Is it overvalued? Is it undervalued? It's overvalued, LOL. Yes, and so I'm probably wrong. Who knows, right? I mean, I do think the stock market's pretty frothy right now. I do think that a lot of stuff is overvalued, but is it by this much? Probably not. But yeah, I would conclude Apple's overvalued. I certainly wouldn't want to buy the stock, right? I wouldn't pay 179 for something I think is worth 130. If I owned the stock, I would probably sell it. If I wanted to really take a risk, I might short sell it, right? Or like buy puts or something like that. I don't recommend that in general, but yeah, so that would be the conclusion from this. So that's dividend discount valuation. We still have 2 models to go, but I'm going to show you hopefully that those give us very similar outcomes. But does anyone have questions about the dividend discount model, about present valuing these dividends, and about using that to then, make an inference about what the stock is worth? Does anyone have questions about that? Okay. All right. Again, just feel free to jump in anytime. So that's our first model, and we've got 2 to go. So the next one is the free cash flow model. And recall the first, I don't know, some of you might not have been here, but the very first slide in this session was these screen captures from different websites saying, why is the free cash flow model better than the dividend model? Or when should you use one versus use the other? Okay. And we'll talk about that. So what we're valuing here, unsurprisingly, guess what? Dividend discount model values dividends. Free cash flow model values free cash flows. In this case, we're again, little caveat, we're doing free cash flows to equity. Okay. Because remember, the intrinsic value of a firm has 2 pieces to it. There's the debt piece and the equity piece. So there's also cash flows to debt and cash flows to the firm, but we're kind of ignoring those here, although I'll touch on that more in just a second. So what is the logic behind free cash flows? So these models did develop separately. That's the interesting thing, right? There were some people doing dividend valuation. There were some people doing free cash flow valuation, and they weren't necessarily talking to each other. So they all thought they had these 2 different models, right? And they each had their own logic. We talked about the dividend model logic. I just want to look at cash in my pocket, basically, as an investor. The free cash flow logic is a little more complex. It thinks about all the different cash flows that a company has. And it whittles it down to kind of the cash that's left over and available to shareholders after the company's done everything else that it needs to do with its cash. Now, this should already, though, give you a little bit of an inkling. Think about this. The cash available to shareholders after all other outlays have been made. I'm just going to, spoiler alert, the cash available for shareholders is the dividends. Okay, that's the cash that's available. So literally, we're going to see free cash flows, if you do it right, is precisely equal to DDM dividends every single year. Okay, again, that requires us to implement our numbers correctly. And the formula we'll see in a minute, it's a little complicated, and I think you'll be able to see why a lot of people maybe make mistakes, and so they don't end up, getting the same valuation. Mathematically, again, all these models are pretty much the same. It's a series of future payoffs, and we're present valuing them. The difference here is, instead of calling this dividends or D1, D2, I have FCFE, free cash flows to equity. Okay. But mathematically it's same. So we still got a lot of the same problems. Like we've got the ... We've got to do a perpetuity. We've got to, get all the payoffs out to infinity. All those same kind of mechanical issues. We are always, again, no matter what model you use, we're valuing equity. So you're always using the same cost of equity. That, of course, would be a huge mistake if you were using different discount rates in the different models. They all use the same discount rate. Okay. All right. And here we go. This is a little more complicated than dividends, right? For dividends, we were like ordinary dividends plus stock repurchases minus stock issuances. Here we have, up to maybe 5 things to think about. Now, not all companies have all of these things, But here's the logic of the free cash flow calculation. So, and this is why we reviewed the cash flow statement as detailed as we did earlier in the session. So we now at least remember that there's 3 sections of the statement of cash flows, right? Operating, investing, and financing. So we start out with operating cash flows. That's the cash flows generated by the company's main line of business, right? Selling its products or services, paying its employees, blah, blah, blah. And so I'm out here as an investor. Remember, again, we're an investor valuing this company. And I'm like, whoa, look at all those operating cash flows, right? $3 billion or whatever, is all that for little old me, right? And then you remember, oh, wait, there's other parts of the statement of cash flows, right? Companies have other things they have to do. So the next line there is investing cash flows. And we briefly reviewed this, but that's basically in finance class, you'd call this the CapEx, the capital expenditures. It's usually a negative number. So even though it says plus investing cash flows, most companies throughout most of their existence, you're adding a negative number here, because what's the company usually doing? It's opening stores, it's building manufacturing facilities, it's building supply chain, whatever, infrastructure. And so it's an outflow. So here I am, little old investor. Gosh, those operating cash flows look great. Can I get some dividends? And the company says, well, no, we had to open up a new $1 billion facility, right? So you have a $1 billion outflow from investing. Okay, great. Now with what we have left now, can I get those in dividends? And so then we have to adjust, because again, we're valuing this from an equity investor perspective. I've got to adjust for any debt cash flows. So imagine the company used some of that money to pay off a bank loan, right? That's cash out the door to the bank that is no longer available to pay me, an investor. So we're going to add debt cash flows. These could be positive or negative. If a company takes a new bank loan, right, and gets cash, then we'd be adding a positive number. If a company repays a bank loan and so there's an outflow of cash, we'd be adding a negative number. Now, you guys might not think of debt like that. I mean, of course, I know the financy folk among you would, but in this model, taking on more debt is a positive thing. A lot of us think, oh, debt's bad, right? Debt's risky, which is true. And if you want to get more into the pros and cons of debt, attend my next session in July sometime, where we will dissect a little bit more of the riskiness and the pros and cons of debt. But from a valuation perspective, for equity investors, more debt is a positive thing. And you know why? Because you could take out a 2%, well, not anymore today, but you could take out a 2% bank loan of $100 million and turn right around and pay me $100 million in dividends as an investor, right? So that's the logic behind why we're adding debt cash flows. Preferred stock, let's not get into that. It's so few companies have it. It's always, a pain in my side to even have to teach it. But long story short, when we talk about stock and valuing stock, we're always talking about common stock. That's the kind of stock that's traded publicly. There's this other weird kind of stock called preferred stock. Most companies don't have it, but just long story short, we treat it the same as debt. Okay, it's just another form of financing, and it's just like a bank loan in terms of this model. But we won't be dealing with that today. So we've adjusted for all these cash flows, and we got the operating. We've added in the investing, which is usually negative, right? They bought a new building or whatever. We've added in any new bank loans or repayments of bank loans. And then here's me, the little old investor, saying, now can I have my dividends, right? Am I entitled to what's left over now? But there's one final very sad adjustment. And the final sad adjustment is we have to subtract the change in cash on the balance sheet. By the way, if you were following along when we reviewed the statement of cash flows, this is also equal to the net cash flow for the year at the bottom of the statement of cash flows. So it's equivalent to the cash from operations plus the cash from investing plus the cash from financing, right? OIF, operating, investing, financing. That gives you the net cash flow, which is equal to the change in cash on the balance sheet. So you could grab this you could grab this from the bottom of the cash flow statement, or you could calculate the change in cash on the balance sheet, and we've got to subtract it. Why do we have to subtract it? because, and I can't remember the name of the student who asked the very good question early on about how much cash companies should hold, right? And do you need a buffer, and how much of a buffer do you need? Because the last thing that a company can decide is, do I want to pay the shareholder the dividends with this leftover cash? Or am I going to hang on to it for a rainy day, right? Am I going to leave it in cash on the balance sheet? And so that's the logic behind this last adjustment, is the company might just decide to hold on to the cash on its balance sheet. So after I start off from hopefully right the top here with hopefully these wonderful high earnings, and I make all these adjustments for everything else the company pays for, and then I finally subtract any extra cash that the company decides to hold on to, I am left with the free cash flows to equity, which is us. Okay. Now, again, you can see this is, I think you'll agree, this is a little bit more complicated than the dividend model, but I'm going to go through and show you it gives us the exact same number. And then after I show you that, prove it by doing it, I'll show you the math behind why it has to be true. Okay. All right. So now one brief tangent. This is where, if you have had valuation before, which I guess you guys probably mostly did in one of your core finance classes, you might be extra confused. So sometimes when I teach classes, I actually prefer the students come in and like don't know anything about valuation, because sometimes it's harder to kind of like unlearn what you've learned than just to learn something new. But so usually, and I mentioned this a little bit a couple slides ago, if you have used free cash flows before, you probably have. You've probably referred to it as a DCF rather than a free cash flows, right? Discounted cash flows. And you were probably valuing the whole firm, which means the equity and the debt component. You probably were using WACC, the weighted average cost of capital, which means you were valuing the whole firm, okay? Again, we're just valuing equity. But you might have also learned the formula significantly differently. I don't know. Again, it depends on who taught your class, unfortunately. People teach it so differently. So if what I'm about to say doesn't resonate with you at all, that's perfectly fine. And if you don't care and you want to just ignore this, that's also perfectly fine, because it's a little bit complicated. But I know there's at least a couple of you that are like, this guy is teaching us a model and he's calling it DCF, and that is not the same DCF that I learned in finance. Okay, so if you're that person, I'm going to convince you, hopefully, that yes, it is. And I know this is very complicated. So let's just take this piece by piece. I want you to focus over on the left. This is the model that I just showed you. It's expanded a little bit because it has to be to show how it relates to your finance model. But I said, what is free cash flows, right? To equity, it's cash from operations, right? Plus cash from investing. You can ignore the little details in between for now. Plus cash flows from debt, minus change in cash on the balance sheet, right? That's literally, right? That's literally what we just saw back here. That's this equation, okay? So that's what's over here on the left. Cash from operating plus cash from investing plus cash from debt minus change in cash on the balance sheet. Okay, now what you did, and this is, again, this is in terms of accounting numbers, like I teach it. What you did in finance, if you did it, was you did the whole firm. And most of this is very similar, okay? Notice that the first two elements are entirely the same. Cash from operations plus cash from investing. But if you want to value cash flows to the whole firm, there are just a couple little differences here. First, notice, actually, there's really just one difference, but it's you take one thing away and you add another thing. So notice in the model to the right, this guy. We're adding back interest expense. And notice what's not there. We are not adding changes in debt. We're not adding any debt cash flows from the statement. And the idea here is, because you're valuing the whole firm, you're valuing the cash flows to debt as well. So you don't want to include them in the model. Just like how the dividends and stuff to equity holders wasn't in the model I showed you. If you value the whole firm, we've got to take the debt payments out. And so we remove that. And that's why we also add back interest expense, because interest expense was deducted from net income. Okay. Now, all these insane arrows are pointing towards the way you probably learned it in finance class, which uses all these terms that we don't use in accounting, such as EBIT or EBIT or whatever you want to call it. Is this DCF model the same as Warren Buffett's? Ron, if I knew what Warren Buffett's was, I could answer the question, but I do not know what Warren Buffett's is. But we can, I'm going to go look after class and we can talk about it if you want to shoot me an email. But, you know, again, in theory, all DCF is supposed to be the same. Okay. A lot of people get hung up on the mechanical parts of it and they think it's not the same. But what I'm trying to prove to you here, so your finance class usually likes to start with terms like EBIT or EBITDA, which is earnings before interest, taxes, and then if they use the DA part, depreciation and amortization. EBITDA in terms of accounting is basically just cash from operations. Okay, it's the cash income statement, right? Because what do? We add back depreciation. Okay, so it's pretty similar to a cash income statement. Then the finance class will tell you to subtract net working capital. You guys might be a little fuzzy or not remember that too well, but net working capital is just the operating assets minus operating liabilities. So see, we do that. That's in our cash flow statement. Operating assets, that we're making those adjustments in the cash flow statement. And then finally, finance tells you subtract capital expenditures. Well, that's just the investing cash flows. Capital expenditures and investing cash flows is the same thing. Okay. So it's a complex set of arrows on how these models relate. And again, if this just confuses you, then fine, just ignore it. But I promise you, this is the exact same logic and theory, if it's done correctly, as you learned in finance class. It may well be, though, that you didn't do it correctly in finance class before, like somebody made a mistake somewhere. That's quite possible. But in theory, they are the same thing. It's just that in accounting, we're accountants, so we like to look at our financial statements. And our financial statements have operating, investing, and financing cash flows. So that's what we're using. We're not using EBITDA and net working capital like we're using our accounting terms. Okay. All right. So the actual model is much simpler than that whole discussion. Okay. So what we have to calculate this, even though it's a little more complex than dividends, we've got, I'm going to abbreviate this stuff, maybe not in a great way, especially because CFO means something else. But in this term, it means cash from operations. Okay. So we've got cash from operating. We're going to add cash from investing. We're going to add cash from debt. Is that how I abbreviate it? I guess we're going to add debt cash flows. And then we're going to subtract delta cash, subtract the change in cash on the balance sheet. Sorry, got a cough again. Bronchitis going great. I apologize for my disability. I'm like, this is covered under the Americans with Disabilities Act, man. You can't penalize me for coughing all over my classes. Okay, so, and by the way, remember, the net change in cash on the balance sheet is the same as the change in cash at the bottom of the cash flow statement. So that 24, if we went back to the balance sheet, change in cash on the balance sheet from year to year should also be 24. And it is, because I made the forecast, so I know it is. Okay. Okay, Ron has direct messaged me Warren Buffett's DCF model. Based on the improved DCF model. Well, you know, if something's called the improved DCF model, then I'm sure it probably is different than what we're doing. Okay, and I'll go look and see how. But, you know, people have a number of adjustments they make to valuation that they claim makes it better. It may be true. It may be true. Okay, Warren Buffett's clearly he's been successful. So Warren Buffett's method may be better. I just don't know. But I'm just telling you, this stuff that I'm teaching you right now, this comes from like economic theory back in the 60s that was refined in finance and accounting over the intervening decades. And now if you just want to apply that, this is how you would do it. But I'm not trying to say that this is better, that nobody has a better version of this. That's not what I'm saying. Okay. All right. So if we do that, we will get free cash flow, FCFE, free cash flows to equity. Okay. All right. Now I'm only going to do a few of these, because it's going to make the same point that the indirect dividend method did, okay? So for 2023, we just have to pull the right line items here, right? I mean, I've already copied and pasted the right stuff that we need here, so we just have to pull the right ones. So cash from operations in 2023 is 101, right? Cash from investing, it's plus, but it's a -4, right? So it's going to end up subtracting 4, right? Because we're adding a negative. We're going to add cash flow from debt. Apple did, for whatever reason in my forecast, Apple took on $4 billion more of debt, or it is expected to in 2023. So we're going to add the 4 billion of debt that it takes on. And then we're going to subtract the change in cash. And the change in cash is the 24. So that's a subtraction, right? That's the extra cash the company's holding on to. So it's a subtraction. And if we do that math, we should end up with 77. And if we roll forward to the next year, we've got cash from operations of 110. We're again adding a -4. We've got 0 in debt. We've got a cash change of 14, and that's 92. And I'll just do one more. So we've also got Apple's not growing too much. They're really not. The Apple's high growth years, according to analysts, are mostly over. So we're adding a -2 from investment. We again have a 0 change in debt, and we've got a change in cash of 15 that we subtract. That's 93. Now I've got so many animations, I don't want to scroll all the way back to the dividend model. But if you go back, if you were to scroll back, you would see these are the exact same numbers that we got by adding the ordinary dividends plus net stock issuance. I mean, you can eyeball it, right? They're still here. These are those numbers, right? What is it in the first year? 77. What is it in the second year? 94 minus 2, 92. What is it in the third year? 97 minus 4, 93. So you can just, I've made the numbers so simple that I actually don't have to scroll back. You can just eyeball these numbers and see that the free cash flow math gives you the same result as the dividend math. You're just using completely different numbers, okay? And we'll see in a minute, I'll show you that that's actually the precise key. The dividends focuses in on these several numbers in the financing section of the statement of cash flows. The free cash flow calculation ignores those numbers, but uses everything else. And so what we're going to see, we're going to end up with an equation where those two things have to be equal. All right. Okay. So that's free cash flow. Now, what about after year plus 5? And again, this is another way that people make a bunch of mistakes in these models, because we learned that there's an indirect method to calculate dividends, right? And we applied the indirect method for the 6th year and beyond. And I showed you in the spreadsheet what a nightmare it is, or it's not necessarily a nightmare, that's overstating it, but it's a headache to do the direct method. Now with cash flows, people will say, but wait, I can't use the indirect dividend method on cash flows because this is free cash flows. This isn't dividends. But guys, that's what I was just talking, like, it's the same thing. It's the same numbers. So why can you not use the indirect method? Okay. So I suggest, and you don't have to, you could go through and do the whole direct method, grow the whole company's balance sheet and income statement at the steady state rate. But the reality is these models give us the same number every year. So you can do the same indirect method shortcut. And so I've just pasted my solution slide here, but this is the exact same thing that we did with dividends, except I am now calling, instead of calculating the DDM dividend here, I'm just changing the name of it. Now it's the free cash flow to equity, okay? But it's the same thing. We're growing net income, we're growing equity, we're doing the indirect method to calculate dividends, or in this case, cash flows, and then we're applying a perpetuity to it. And so we end up with the same numbers. And so I've copied and pasted, again, basically my solutions. I'm not going to write all this out again. I've copied and pasted this. This is the same exact slide. This is the same exact numbers. This is the value of equity we got with dividends. This is the value per share we got with dividends. There's one difference between these two slides. Or I guess two differences, but I have, instead of calling it DDM dividends, it's now called free cash flows and the present value of free cash flows. Okay. But it doesn't matter what you call it. They give you the same numbers and they're just calculated differently. Now let's go in a little more detail. I'm going to talk about in just a second on the next slide, the logic and the math of why these things give you the same result. Does anybody have questions about this? We've just calculated free cash flows for the next 5 years, and then year 6 and beyond, we present valued it. And the only difference between this and dividends is dividends used ordinary dividends plus stock repurchases minus stock issuances. This method, it's a different formula: cash from operations plus cash from investing plus cash from debt minus the net change in cash for the year. So 2 different formulas, but everything else is the same once you've calculated those formulas. Okay. So hopefully this won't be too rough. I don't think it is. I'm going to try to prove to you, using the power of accounting, it seems like I like accounting way more than I do. I actually really like finance, and like I'm very interested in many different things, but I'm an accounting professor. So using accounting, I'm going to start with the basic equation that represents the statement of cash flows. And again, this is another reason why we reviewed the statement of cash flows. The statement of cash flows, you go back to slide number 4 or whatever in this session, right? The statement of cash flows has 3 sections: operating cash flows, investing cash flows, and financing cash flows. So I'm representing those here: operating, investing, and financing. And if you add up the cash flows from those 3 sections, as we saw many slides ago, you get the total delta cash or change in cash for the year. So that's just the basic. If you think of the fundamental balance sheet equation as assets equals liabilities plus equity, this is the fundamental cash flow equation. Operating plus investing plus financing equals the total change in cash. Okay, so that's undebatable, I hope. Okay, so now I've done a little bit of algebra, or I guess a little bit of accounting. I am separating the financing section of the statement in cash flows. Remember, what's in the financing section? Go back to your finance classes, right? Debt and equity, right? You can either take a bank loan, issue bonds, that's debt, or you can issue common stock or pay dividends, right? Repurchase stock, that's equity. So I'm just recognizing that the financing section has these 2 different components in it: equity cash flows and debt cash flows. Okay, anybody have questions about that? Okay. So now I'm going to cough again, sorry. I'll get through this, I hope. Okay, all right. So now all I have done, although this might look like a big change, is I'm going to move the cash from equity, the cash flow from equity to the other side, and I'm going to move delta cash to the opposite side, right? So I'm just subtracting each one, right, from both sides. And so what I end up with is that third equation there, where I've got operating plus investing plus cash flows to debt minus the change in cash is equal to the negative cash flows to equity. Now, just because we've just learned this might not look that familiar. That is the free cash flow formula we just learned. That's what we were just doing, right? Operating plus investing plus cash flows to debt minus the change in cash on the balance sheet. So check it out. On the left side of this equation, I've got the free cash flows. That's the free cash flows to the equity. What's that thing on the right side? So it's the equity part of the financing cash flows, and it's got a negative sign on it. That's the DDM dividends. That's the DDM dividends. What are the cash flows to equity? Remember, stock issuances, stock repurchases, and ordinary dividend payments. That's the cash flows to equity. And remember, we were flipping the signs on those, right? To the firm, it's a $77 billion negative cash flow for dividends. To us, we reverse the sign. It's a $77 billion dividend, positive dividend to us. So that's where the negative comes from. So this slide right here, I don't have to go into economic theory. I don't have to have a debate with a professor who teaches it a different way. This is like the most fundamental basic cash flow logic of the cash flow statement. And I hope that it shows just algebra, with 6th grade math, essentially, and a little bit of accounting knowledge. Free cash flow is always going to be equal to dividends when we're talking about equity. And then if you're valuing free cash flows for the whole firm, then that's a different animal because you've got debt cash flows and stuff like that in there. But does anybody have questions about this? If you were a student in my class, in like my financial statement analysis class, I would never like throw this up on a test and be like, hey, do the algebra. Like this is just for pedagogical purposes. Okay. So there's no reason, I don't think, for you to memorize this or something like that. It's just to show you that you could go back to this and be like, yeah, they got to be the same. Okay. Okay. So there's one more valuation model left. And it's not going to be quite as boring as you might think, because it's not going to give us the same numbers every single year like the others did. So we're done seeing 77, 92, 93. We're not going to see those again here, okay? But magically, seemingly magically, the total value of the equity is still going to be the same under this model, okay? But this model uses very different logic than the other 2 models. And so again, kind of like we did with dividends, we're going to start simple and build up a little bit more complex as we go, okay? So this model is called the residual income model. And it has a couple moving pieces to it. So, I mean, logically, this might be a little harder to understand than the other two models. It just depends, but it depends on how your brain works. For some of you, it might be easier to think about valuation this way. So we're basically going to start with this is just kind of like a basic finance assumption, right? That like when you invest in something, there's some level of return that you expect. And I'm going to give you a spoiler alert. That level of return is based on that capital asset pricing model we talked about. It's that cost of equity, that expected return on equity, the R sub E. That's the rate that we require. But we'll get into that more in a minute. Anything above and beyond that like core level of expected return is like a bonus. It's like, and so we're going to, in this model, we're going to think about that as abnormal or what we call residual earnings or residual income. Okay. Now, for those of you who are really done a lot of valuation before, you may have encountered the concept of EVA or economic value added. I don't know why people teach this stuff. I mean, maybe it's made its way into finance textbooks. I don't know. EVA is just like a commercial bastardization of the original residual income model framework developed in research. And these guys in a consulting company took it, they changed the terms to, instead of using earnings, they're talking about NOPAT and all these, sexy finance terms. But at the end of the day, all that did was make it just a lot more places for you to make mistakes and not get your valuation models to match up. So I'm sticking with the core, the original accounting definition of all these terms. But again, in theory, if you implemented all this stuff properly, EVA and residual income are in theory the same thing. Okay. As long as you don't mess it up with some misunderstandings. Okay. So, all right. So we're going to start with really basic logic. I hope it's pretty basic anyway. It helps me think about it. I hope it helps you think about it. So we're going to start just thinking about the case where you just buy a share of stock. Okay. And what would make you happy? If you buy a share of stock, what do you expect? Okay. So let's say you buy a share of stock for $50. And let's assume that you are behaving consistently with economic theory, which is that capital asset pricing model that says the beta, right? The beta risk and the market risk, that's what determines your expected return. Okay. So let's say for this specific stock, we're keeping our numbers simple, okay, for calculation purposes. You expect an annual return of 10% on this investment. So let's convert the percentage return into a dollar return that you expected, right? How do we do that? How much dollars in return do you expect annually, right? Well, you put in 50, right? That's what you bought the stock for. You expect a 10% return. So what's that? This is not a trick question. If you expect a 10% return, that's a 0.1 on $50 investment, you expect a $5 return every year. Okay. And, how do we get that expected return of 10%? That's the R sub E equals the risk-free rate plus beta times the market return minus the risk-free rate or the market risk premium. So that's back. This is why another reason why we briefly touched on the capital asset pricing model. It's just the idea that as risk goes up, the cost of equity or the required return on equity goes up. And that's what feeds into this idea of what kind of return do I expect? And again, our simple assumption going throughout this whole lecture is 10%. That's clearly not true. Some firms need 14%, some need 7%. I'm just picking a generic, easy to calculate percentage. So yeah, so if you put $50 into an investment, you expect a 10% return, you're expecting $5 per year. I don't think that's controversial, right? So let's flip it a little bit. You've got this. Instead of figuring out, what we expect, let's deal with a situation where, we've bought the stock and maybe it returns what we expect and maybe it doesn't. And let's flip it around and compute the value, right? Was this stock really worth $50? Was it worth more? Was it worth less? What's this stock worth? Okay. Now I'm going back to the idea of a perpetuity here. Now, up until now, we've done a perpetuity with growth where I would subtract G, right, in the denominator. But here, let's just assume there's no growth, just for simplicity, okay? So I don't have a minus G in the denominator. I've just got, right, the payoff or the cash flow divided by the discount rate. That gives us the, right, that gives us the present value of all those future payoffs. So you've got this $50 share of stock. Let's look at the case where it actually is going to return $5 per year, right? So if I expect to get $5 out of this investment every year, that's simple. That's a perpetuity. So I can use the perpetuity equation. Again, we're assuming a cost of capital or an expected return of 10%. So if I do $5 divided by 0.1, guess what I get? $50. Oh, wow. So you're telling me that if this stock that I bought returns exactly the dollars that I expected every single year, then the perpetuity is telling me that it's worth exactly what I paid for it. And that should make sense, right? If you invest in something, if it earns exactly what you require it to earn, then you pay the right amount for it, right? What if you got good news? What if you're like, oh my God, they have some new product, they're amazing, or like they have some new cost saving method, they're going to earn $6 per year, right? The firm, this firm's going to earn $6 per year. Now, I've got $6 in the numerator. Again, my required rate of return has not changed because that's computed based on the riskiness. That's computed based on the capital asset pricing model. Now this thing is worth $60, right? That's just the math. So if an investment earns exactly what you expect or you require out of it, it's going to be worth exactly what you put into it, right? You put in $50 to the stock. Congratulations, it's worth 50. They're going to earn $5 every year. If you get great news, the earnings are going to be higher than you thought. Really, congratulations, because now that investment is worth way more than you paid for it, maybe, right? In this case, $60 instead of 50. Now, in this example, you should be able to turn it back around in the stock market and sell that now to somebody for $60 now that this news has come in. Okay. All right. Now, there also, of course, is the sad case where you buy the $50 stock and you hear bad news. The company sucks, right? And now they're only going to earn $3 per share or $2 or $0. Now, if we plug that in here, your investment is worth a lot less, maybe worth nothing, right? Okay, so that's kind of the logic behind the residual income model, although it's a little more complex than that because we're not just dealing with one share of stock, we're dealing with the equity of the entire firm, right? Because that's what we were doing before. We were valuing the cash flows to all of the investors, all of the equity holders. So we have to look at this from like a firm level, not like a per share type of level. And we're going to have a couple new terms to introduce here, but we can still extend it based on the single share of stock logic, I hope. So essentially, a company's cost of equity, all right, that R sub E, that is the rate of return that the investors require on the investment, just like we were just talking about with a single share of stock. Okay. But now, if I'm talking about the whole company, instead of looking at my individual return that I expect each year, I want to look at the total return that the total company is generating. And for the total company, the total amount of return they're generating with their investment is the net income. Okay. And so we're talking about this is going to tell us what level of income do I require or do I expect this firm to generate? Okay. But then we need to know, so how much is invested? In our simple example just now, it was you putting $50 into a share of stock, right? Well, we've been looking at balance sheet numbers, right? We were talking about the equity section of the balance sheet. The equity section of the balance sheet represents the shareholders' total investment, right? It's got the invested capital and the retained earnings. So all that together, that equity, that's shareholders' total investment in this company. So when we're computing, gosh, how much income do we expect this company to earn? We are looking at the entire equity on the balance sheet because that's the investment. That's what the company has to work with, that we, the shareholders, have invested in this company. So every year, I'm going to look at the amount of equity that they started the year with. I'm going to multiply that by the cost of equity or the required rate of return on equity. And that's going to tell me how much income does this company need to generate to make me happy or to make me satisfied, right? But guess what? Just like with the individual share of stock we just talked about, this company might be doing better or they might be doing worse than what you initially expected when you invested with them, okay? And that's where the concept of the residual income comes from, okay? So we're gonna take this required income from up here, what we expect them to earn, and we're gonna compare it to what they're actually gonna earn in the future. And where does that come from? It's back to those forecasts, right? Where I show you that spreadsheet where I've got the future financial statements. Just like I was forecasting how much dividends they're going to pay and how much, assets they had, I also forecasted the net income, right? And I forecasted the total ending equity every year. So I'm pulling what I think is actually going to happen in the future. I'm pulling that from my own forecast. So you got to be really confident in your numbers, right? When you're doing these valuation models, you're the one who's created these numbers. All right. So if I'm forecasting the company to earn way higher income than what is required by investors, then the company has positive residual income and they're going to be worth more. If the company is going to do crappy and they're going to have low income in the future, then they're going to be worth less. And so this is what this model looks like mathematically. It's a little bit different than the others because it has an extra term in there, okay? And the extra term is right here at the beginning. So the intrinsic value of the company, we start at a baseline that the company is worth whatever's invested in it right now. So we go to the balance sheet, we look at equity. You can do this with any company. Pull up their most recent balance sheet, look at their stockholders' equity, and as a baseline rule of thumb, that's what the company's worth. Or at least that's what the company was worth when the investors invested the money. Now, some companies are going to be doing worse than expected. Some are going to be doing better than expected. And that's where all this future stuff comes in. And the RI is the residual income. So if the company earns, now let's go back and look how we calculated. Let me erase some of this stuff so I can draw some more reference points here. So let's look at how we calculated that required income real quick. All right. So the required income here is equal to the cost of equity times beginning equity. Okay. Question? Oh, okay. All right. I don't know if Evan's with us. He might not be policing the mute button, but okay. All right. So, do it. So the required income is the cost of equity multiplied by the beginning equity, right? And here we start with the first term in this model is the beginning equity, all right? And the residual income is only the amount that the company earns that deviates from the expected income or the required income, all right? So if the company earns exactly R sub E rate of return, right, the cost of equity return, if the company earns exactly that, that's all right, Evan, thanks. I really appreciate your service on this. You're not slacking, it's fine. I don't know what it would be if we didn't have you to monitor this. It was an excellent suggestion. All right. So if the company earns exactly what shareholders require or expect, then there won't be any RIs in the future, right? Essentially all these guys are going to go away if the company earns exactly the required rate of return. So then it would just be worth the balance sheet equity. But if I personally, right, I made these forecasts, if I'm predicting they're going to do even better than expected, then I'm going to end up with these positive future residual incomes. All right. So maybe just doing it might make it simpler than like talking about it in an abstract way. So notice again, kind of like the indirect dividend method, I have no statement of cash flow items here. So this just, again, should highlight why some people make mistakes and don't think these valuation models give you the same thing. Because if I'm using this valuation method and I'm just solely focused on equity and net income, and then I'm doing free cash flows where I'm using all these individual cash flow line items, there's just a bunch of places for me to make mistakes and not have the same result. But hopefully here, we will get the same result. So again, just like the indirect dividend model, I need 2022 is last year because I need to know the beginning equity. Okay. For the dividend discount model, it was so we could compute the change in equity. But for this residual income model, I need it because I need to apply my required rate of return to that equity, to that shareholder's investment, because that's going to give me my required income. Okay. So every year on this slide, we're just calculating the residual income in all these future years. Okay. So to do that, we get our forecasted income. This slide is going to be a little bit busy. A forecasted income minus our required income, sounds simple, equals our residual income. It sounds simple, but we have to actually compute the required income, which is kind of has 2 steps to it. All right. So the forecasted income is just the net income from the forecast that I made, right? If you were doing this, you would have forecasted your own financial statement. So it would be whatever you thought Apple was going to make. So I'm going to bring the first year. They won't line up, but 2023, we're going to start with. So the forecasted income for 2023 is, that's equity, is 100 billion. Okay. So forecasted income is 100 billion. Required income is the required rate of return times the shareholders' investment at the beginning of the year. The shareholders' investment at the beginning of the year is the 56 billion of equity. So I'm going to take, minus 56 billion times 0.1, the required rate of return, 10%. Now the numbers are pretty easy to do in your head, right? We're going to be taking 10% of the beginning equity every year. So what's 10% of 56? It's 5.6. So the residual income in this case, we only required the firm Apple, this is Apple, we only required Apple to earn 5.6 billion. Apple actually earned 100 billion. So the residual income is 100 minus 5.6, or 94.4 billion. Okay. That's how well Apple's doing. Apple is working with such a small shareholders investment and is generating so much freaking income that Apple's just like, Apple's earning 10 times or more what it really needs to earn based on its riskiness. Okay. And that's why its stock price is so high. Okay. So in 2024, we just have to roll forward with this, and we've got the forecasted income is 105. We're going to subtract. Now it's 79 times 0.1. Okay, so you always have to keep rolling forwards with your equity, right? At the beginning of each year, you're starting the year with a new overall level of shareholders investment, right? So you always got to start with the ending equity from the previous year. So now we're doing 105 minus 7.9, and that equals 97.1. I'm going to start not like writing all the math down here. So then we've got 108. I'm just going to take the 10% in my head. So we got 10% of 92. So that's 9.2. So 108 minus 9.2 is 98.8. Then we've got 110 minus 10.7 is equal to 99.3. And then we've got 111 minus 12.2 is equal to 98.8. Now, okay, so that's it. So those are our residual incomes for the next 5 years of Apple, right? It's whatever income I forecasted minus the required rate of return multiplied by the investment, which is the equity on the balance sheet. And that gives us our residual incomes there. Now, this is the only one I'm like almost just barely able to put this here. Now, for the other models, we went to a totally separate slide for 2028. Remember, because we switched to the indirect method, and we're like, oh, we got to calculate the net income and the equity for 2028 and then plug it into the perpetuity. Because it's a little bit simpler here, I think we can fit it all in one slide. So I've got 2028 right here, and I need to know what the residual income is for 2028. Now, how have we been calculating this? We've been taking the net income that was forecasted for the year, and we've been subtracting the previous year's equity multiplied by the cost of equity. So for my required income for 2028, do I need any new numbers, or do I have what I need? Guess what? I have what I need, don't I? Because look at my required incomes for the other years. It was always, in 2027, it was 12.2, which was 10% of 122. So for 2028, it's going to be 10% of 136. So I've already got the equity number I need to calculate my required income. So I know this is going to be minus 13.6. That I know. The only thing I don't have is my forecasted income for 2028. And this we do the exact same way we did with the other models. We take the 2027 net income, okay, of 111, okay? So we take 111 and we grow it at the steady state growth rate, just like we did in the other models. And we will end up with the same income as well as we did in the other models. If you don't recall, 117.7, that is what we ended up with. So we plug that in here, 117.7 minus the required rate of return equals 104.1. And that's the 8th year. So it's a little simpler than the other models. We don't need to grow equity and calculate the change in equity. We kind of just keep doing the same thing. We just need that one last year of forecasted income that we create by growing it at the steady state rate, okay? But then again, this whole guy, then to get to 2028 and beyond, right, we need a perpetuity. And so our perpetuity of residual income is equal to 104.1. Again, this is just the same way we did all the others. 104.1 divided by cost of equity minus the growth rate, right? So that residual income is going to keep growing at a steady state rate forever. And that gives us a perpetuity of 2602.5. So we don't need another slide for the 6th year and beyond. It's all here. It's all on this slide. Those are the numbers. We still have to present value all this stuff back to the present. But does anybody have questions about this? So basically, you see all these positive numbers. It means Apple is performing so well. They're earning way higher income in the future than would be required based on their cost of equity or their riskiness, right? Their riskiness says they should earn 5.6 billion, 7.9 billion, 9.2 billion. Instead, they're earning 100 billion, 105 billion, 108 billion. So they've got these, tens of billions of dollars of positive residual income. If I had forecasted Apple was going to perform like crap, these could be negative numbers. Apple could be destroying value, which I think a lot of companies are. Any questions about this? We're near the end, guys. I know it's a lot. So let's just plug these numbers in and just do the same thing just to satisfy ourselves numerically that this gives us the same conclusion as the other two models, okay? So the residual incomes we just calculated were 94.4, 97.1, 98.8, 99.3. I don't think this is a typo. 98.8 again, is that what it was? Yeah, it was, just coincidental. 98.8 again, and then the big 2602.5 perpetuity. We're using the same discount rates, right? The 1 plus the cost of equity that we did in the other models. So we've got our 1.1s, taken to the number of powers. Again, don't ever forget, the perpetuity is also discounted back by 5 periods, not 6. And then we get our present value of residual income. And again, there are some rounding issues here that will result. This is going to deviate like by, 0.5 or whatever from the other models, just because I'm very bluntly rounding a lot of this stuff. But sorry, that's a 6, 15.9. All right. So now I'm going to sum all these up, sum all the present value of residual incomes up. And if I did my math right, that's 1985.1. Now, with the other models, we were at a value of equity of around 2040 or 2 trillion, 2.04 trillion. Here we're only at 1985 trillion. Did I do something wrong? Did I forget something? And a lot of people do. And yes, I did indeed forget something. It's easy to get caught up in all this math, right? Because we did all this stuff on this slide. We calculated all these numbers, all these residual incomes. But don't ever forget, let me again erase some of this crap. Don't ever forget, all that stuff we just did, on that slide was only the residual incomes. That's what we just did. We cannot forget the baseline assumption, right? Which is that the company is initially worth the equity that's invested at the beginning of all this, right? So all these residual incomes, that's just the abnormal future performance on top of the current equity that's invested. So we need to add that starting 56 billion in equity here. So I need to add 56 billion in starting equity as a baseline. And if I get that, I get 2041.1. Again, it's off by like a fraction of a billion from the other models. It's just because of rounding. The shares outstanding are still 5.7 billion. And still, even with the rounding, we still get to a value per share of roughly $130 per share. So these three valuation methods, I got a few more slides to go, but we're done mostly. I mean, these are the models. The models are done. So all three of these models have yielded $130 per share for Apple. It doesn't matter whether we looked at cash from operations and investing, or if we looked at stock issuances and dividends, or if we look at abnormal income. It doesn't matter which one we look at. They all give us the same valuation. Ron says, wow. Okay, I'm glad somebody thought wow about this. I think it's pretty cool too. And it's very easy to make mistakes in your forecasts, and so you won't get the right things. But the first time you sit down and do forecasted financial statements and you do your three valuation models, they'll never work out the first time. But you go back and you correct all your little errors and they spit out the same valuation. It's very it's comforting and rewarding. And you're like, now I know I did it right. Okay. So I would never just do one valuation model. I always do all of them, because that's the only way I know to check for errors, really. So I want to make sure my balance sheet balances. I want to make sure my statement of cash flows matches up with the change in cash on the balance sheet. And then I want to make sure all my valuation models give me the same valuation. Those are the only ways that I really know to check my own forecast, to see if there's a problem, see if there's an error. Okay. Well, someone asked a question in chat. What are red flags for you that numbers provided by companies are creative? So that's a whole other, so when I teach financial statement analysis, I have a brief section on company fraud and creative numbers. Long story short, it's really hard to figure out when companies are cooking the books. I provide students with one spreadsheet where you can kind of fill in, you can copy and paste numbers from your company's financial statements, and it will spit out a probability that your company committed fraud. Well, it keeps trying to correct I'm trying to type in the guy's name and it keeps auto-correcting his name. It's called the Benesh. Oh, whoops. I'm private messaging somebody. It's called the Benesh fraud model. I can ask Paolo to post it. Again, I don't know how stuff gets to you guys and if it actually makes it to Canvas or not, but it's called the Benesh fraud model. And that is Daniel Benesh. Keeps correcting his name to Beneath. Daniel Benesh at Indiana University. Okay. So, but still, it's not, and he'll even say, look, this model, it's okay. It helps us find fraud, but it's not perfect. Eyeballing company financial statements for fraud is really tough. I mean, there's some red flags you can look for. Did they have a big change in their accounting method, right? Did they change the useful lives of all their assets to, make their depreciation lower? Did they convert their inventory accounting method? So I think anytime there's big changes in accounting methods, I'd be worried. Anytime the chief executive changes, I'd be worried because they have different incentives. But that's kind of another topic. I think it's very interesting, but you're right. We're assuming in this that the company's numbers they've given us are reasonable and accurate because we're basing our forecasts on those numbers. So that's another big caveat or if. Now, so the big takeaway, I want to summarize this, that all the models give us the same result. Now, I want to point to what I pasted right in the early slide, that I still hear from tons of students and professors and practitioners everywhere. I hear this quote: I can't use the dividend discount model because my company doesn't pay dividends. It sounds very logical. Simply yeah, they don't pay dividends. How can you use a dividend discount model? Okay, but I just showed you the residual income model, which doesn't consider anything about dividends. The residual income model gives you the same valuation. So if you can use the residual income model, then you can use the dividend discount model and you can use the free cash flow model because they all give you the same result. But it is tempting to say, but if there's zero dividends, what's going into the model? And so this is kind of the last thing I want to show you. So let's use Apple. And I was going to click in back into the spreadsheet, but I don't think I'm going to do that. Just take this slide for granted, because I don't think we have time to click back into the spreadsheet, and I was going to modify some stuff. So I did this. Just trust me that I did this in the spreadsheet and then I pasted it here. So this is a reworking of the dividends Apple paid. You know, we had that Apple was paying 77 billion in dividends, you know, and 90 billion in dividends. And we had that Apple was also issuing some stock. I have done, you know, what scares everybody, that like, you know, I can't use a dividend model because everything's a zero. Okay, fine. Everything's a zero. Look at it. It's right there. Everything's a zero. But then what happens, right? Because all these financial statements are interconnected. Okay. If Apple doesn't pay dividends, then where does all that money go? It just stays in retained earnings. It just stays in equity on the balance sheet. So what happened when I made this adjustment, right? Apple pays out nothing. I didn't change Apple's sales or earnings, just to be clear. So Apple's just hoarding all of this cash, and they're storing it up in equity in the financing section, and they're storing it up in cash and assets. So Apple looks like a really bad company. Getting back to I think the first question asked on this session, what amount of cash is too much? Apple looks terrible if you do this, because they end up with, at the end of the day, $603 billion of equity, and they're still only generating 111 of net income. So they looks terrible. It looks like their percentage, you know, really bad. But but that's fine. So now Apple looks worse, but we still are doing the same. We still have to grow the company at the 6% steady state growth rate in year 6. We still have to do that, because that's the theory. The company grows at 6% forever after. Well, guess what? If you grow a company at the steady state growth rate and then calculate the year plus 6 dividend, there will be a dividend. So all you're doing when you have a company that pays 0 dividends, it still has equity, it still has net income. All you're doing is pushing the anticipated dividend payment farther and farther and farther down the road until it ends up in the perpetuity. Okay? So it's just simply not true. You can't use a dividend discount model when a company doesn't pay dividends. All it just does is it just makes the assumption that they pay it out in the perpetuity. Now, it does end up making the company look a lot worse. I mean, this is a much smaller perpetuity than we had originally calculated for Apple. So I'm not saying it won't affect your valuation, but if you can use one of these valuation models, you can use all, and we're not going to go look. We're not going to go look. But that slide showed you, if you can use one, you can use all. It doesn't matter if the company didn't pay dividends in the next 5 years. That's okay. Now, you could end up in a weird situation. Where your perpetuity dividend stream, where you have a 0 dividend or a negative dividend, you could end up that way. But that would only just be because the company's doing so badly, right? Like their net income is so low that when you grow the company at the steady state rate, that calculation doesn't pop out a positive dividend. But that's fine. That just means your company's doing terribly. But that's a whole different issue, okay, on whether you can use one model or the other model. You can always use all 3 models if you do it correctly, okay? All right. So I just want to leave you with one thing that I hope is a little bit of fun. I mean, fun is I'm using the term very loosely. So we're done talking about all the mechanics of the models and stuff like that. And now let's talk a little bit about residual income model again. Because one of the reasons I like that model is because the logic is totally different. Even though you end up at the same place, the logic is totally different than the dividend model and the free cash flow model. And it talks about the required rate of return, right? The required income versus what the company is actually earning. So GameStop, right? I'm very interested. I was more interested 3 years ago because it keeps right? The stock just keeps being inflated by insane Reddit investors. So it's kind of just the same story over and over again. But I just went to check the other day. It's actually probably worse than it's been in a long time in terms of being overvalued. Its current market valuation, like the total market value of its stock, is 6.5 billion, right? That's the price, all the stock shares multiplied by their price added up together. So let's think about the residual income model. And let's use that logic to do a little bit of back of the envelope calculations on what level of net income GameStop needs to generate to justify the current value. the 6.5 billion. Okay, so before you guys think, I'm going to go invest in GameStop, which probably nobody's thinking, I hope. But let's just do a back of the envelope calculation. I don't need to do any forecasts. I don't need to do any complex financial statement stuff. This will tell me, I think, a lot of what I need to know. So right now, if you look at the balance sheet of GameStop, they have $1.3 billion in equity. Okay, that's the dollars of shareholder investment that GameStop is currently working with to run its business, to generate its return. Let's assume the cost of equity is 8%. Don't ask how I got that. I talked about earlier, GameStop's beta is like 0 or negative now, but that's just because it's now completely disconnected from reality. Okay, I used a beta of 1 here, which is very generous. I think GameStop's cost of equity is probably more like at least 12%. So but by assuming 8%, I'm assuming the absolute best case for GameStop. This is going to provide the lowest required net income, right? Because that percentage tells us how much we expect GameStop to earn. So I'm understating this, okay, just to be completely conservative and fair. All right. It may be relevant to know that up for the last few years, GameStop is consistently generating a $300 million loss. They are not generating a positive net income. They are losing hundreds of millions of dollars every single year. Obviously, they're trying to turn that around, right? And that's what all these investors are betting on. They're going to turn it around. Let's see how much they have to turn it around by, okay? So we know from the residual income model, right? IV0 equals the balance sheet equity at time 0 plus, that's a sum. I know that's really messy. The sum of all the future residual incomes, right? Residual income at time 1, 2, 3, 4. So we know that the intrinsic value of the stock should be equal to its balance sheet equity plus its residual income, okay? Now, the intrinsic value of the stock right now, let's assume the investors are right. Let's assume the intrinsic value really is 6.5 billion, okay? So 6.5 billion should then be equal to, if it's properly valued, should be equal to its balance sheet equity right now, which I just wrote up there as 1.3 billion, plus the sum of all future residual income. Okay, so if I do a little math here, this tells me what? Let me subtract 1.3 from both sides. This tells me that there's basically 5.2 billion of GameStop value that needs to be justified by future residual income. Okay. Now, again, back of the envelope calculation, let's just assume residual income is going to be constant over time. That's an easy assumption. So, what level of constant residual income will we need to equal 5.2 billion? And that we can do in a perpetuity, right? A perpetuity. So if I want to figure out what level of residual income in perpetuity would give me a $5.2 billion valuation, then that's it, right? It's the residual income next year and assume it's going to happen forever, right? And that's divide by the cost of equity. So if I do that, I get that RI1 equals $416 million. That's just the residual income they need. Remember, what's the required income? What's the required income? The required income is the cost of equity, 0.08, multiplied by the current balance sheet equity, 1.3 billion, and that is 104 million. So GameStop, the net income that GameStop needs to start generating on average over all future years is the required income plus that residual income, which is a total income of $520 million per year. So if GameStop is worth what it's currently being traded at, 6.5 billion, to justify that, this company needs to make over $500 million a year in net income. They are currently losing about $1/3 billion in net income. At no point in their history, even when they were a much bigger company, have they ever made $500 million in net income. So this just using the residual income logic, back of the envelope calculations, we can just see that the valuation appears to be absolutely insane. They're doing an earnings announcement next Wednesday, I believe. So maybe we'll hear very good news. I don't know.